Good afternoon, members present here physically and virtually. Welcome to the half-day seminar on faceless assessment and reassessment. Today, we have Sri H. Padamchand Khincha sir and Chythanya sir. I request our chairman to escort the speakers onto the dais with a floral bouquet. Of course, Mr. Chythanya sir will be joining us shortly. Thank you, sir. I request our chairman, C.A. Srinivas T, to welcome the members.
Respected Padamchand Khincha sir, members present physically and virtually, I welcome you all for the half-a-day seminar on faceless assessment and reassessments. We have a very encouraging number of faceless delegates for faceless assessment rather than physical presence. It's a very interesting topic for various reasons. As you all know, the objective is imparting greater efficiency and transparency and accountability, eliminating physical interface between the taxpayer and tax officers. With this objective, Section 143(3)A started, but even now, lot of hassles in that faceless assessment. Majority of the members also facing a lot of problems on faceless assessment and reassessments. To address, to discuss those issues, we have an expert speakers like Padamchand Khincha sir and K.K. Chythanya sir. We can discuss our queries, any queries you can ask and get clarified with sir. I once again welcome you all for this program. We have very interesting programs in this month as well as next month. We have a one-day seminar on virtual digital assets. The entire one-day session has been divided into 5 sessions. 2 speakers, one from CPA and CA from US, they are going to address on that evolution of digital assets and how it's a tradability, buy and sell, everything they are discussing. Regarding legal aspects, we have a High Court advocate speaking here, and income tax and GST applicability, we speaking with the 2 eminent speakers. It's a one-day, full-day session. I request members to join for that program. And May 6th, 7th and 8th, we have a RRC residential refresher course in Madikeri, 3 days, 2 days and 2 nights in Paddington Resorts. I request members to register those program. With this, I welcome you all for this interesting session. Over to MC.
Thank you, Chairman. I would take the privilege in introducing Mr. C.A. H. Padamchand Khincha sir. He is a partner in HC Khincha & Co. Bangalore. He doesn't need any introduction, of course, in our profession, but I still do take this as a formality of it. With over 30 years of experience in corporate and international tax regime, he has spearheaded the income tax consultancy and litigation practice. He is also commerce graduate from University of Bangalore, securing 5th rank at the university level. He holds a bachelor degree in law. He is a qualified chartered accountant in 1982 by securing 25th rank. He has represented large corporates in some of the high-profile cases before the various income tax tribunals across India, and he has been associated with several landmark decisions too. He is also a prolific writer on various topics in income tax. He has co-authored Tax Holiday under Section 10A and 10B, an analysis, Tax Treaties of India, a compilation, Capital Gains of Non-Residents, tax reduction at source, concept of indexation under capital gains. He was instrumental in making a critical analysis of the direct tax code as a member of the team constituted by ICI on the request of CPDT. I welcome you again, sir. Also, I would like to introduce Chythanya KK, who would be joining us shortly. As a chartered accountant for 14 years, specialization in taxation matters, and advocate for 17 years in various high courts and Supreme Court, designated as the senior advocate by the Karnataka High Court in the year 2021. He's lectured at IIM, ICAI, and DTC of Income Tax Department at various other forums, presented papers in income tax, VAT, GST at various metros and other cities and forums of ICAI. He is a member of the study group of ICAI for forming guidance note on transfer pricing. He has co-authored various other books. He has contributed articles to the ITR, Chartered Accountant, BCAJ, Taxman, CTR, and other journals. Disposed before the Committee on the Direct Tax Matters headed by Honorable Justice A.P. Shah on the levy of MAT on FII. Country reporter for India for IFA, Seoul, Congress 2018 on withholding tax. With this brief introduction, I would like to hand it over to the speakers of the day. So would you like to, you can proceed. Yeah. With a big round of applause, I welcome Padamchand Khincha.
Chairman of the Bangalore branch, Mr. Srinivas, Secretary, Mr. Pramod, Treasurer, ladies and gentlemen. This topic was designed to be discussed in the preceding month. But then we told the chairman to kindly defer it because we wanted the bill to become an act. At the time it was originally scheduled, the bill had yet to be converted into an act. And therefore, we told the chairman concerned, there have been significant changes in the entire process of assessment in the last 2-3 years. We don't know what will be the journey between the bill to the act stage. Therefore, we requested the chairman that wait for some changes, if at all there are going to happen. Because we find that there have been a good amount of transition in the process relating to assessment, at least in the last 3 years. This e-assessment began sometime here, about 8-10 years ago. And as technology has improved, the government has initiated a lot of these e-initiatives. They would like to therefore have everything automated. They believe that this automation helps in delivering better services to the taxpayer, also helps in improving transparency. Everything therefore is available for the purpose of examination by people who are participating in the entire process concerned. We all believe that this aspect of services to a taxpayer is not actually met in reality, where we are now visualizing the way in which assessment orders have been passed, the way in which replies have not been properly taken into account, the way in which the portals have been designed, technical glitches are happening. We are finding that certain replies are not being reflected on the portal concerned. So a lot of problems are being faced by the people who are advising clients concerned. And we are therefore finding that this is not becoming the way in which it was projected to be so. One possibly could say that we are in the process of transiting to a fully electronic mode. And therefore, this technology glitches may be sorted out over a period of time. There are also a time constraint in the recent time because of certain reasons, because of the COVID pandemic and everything getting deferred. There were also a sort of a crushing into terms of how do you comply with this condition by 31st March. There was a great hurry to do things concerned, as a result of which possibly there have been certain lapses in terms of the department not being able to meet the conditions expected of them from the assessor's side. what's important for us to understand and appreciate is that assessment is the most important function under the entire Income Tax Act. All that we are doing, all the changes happening in the entire proceeding process, maybe in relation to computation, business income, capital gain, set off, carry forward, all that we have under the Act is from the assessor's point of view, initial portion. Then we have the income tax authorities in their powers. So from 119 onwards, 116 onwards to be technically, we have the income tax authorities and goes on. The section thereafter goes on to outline the powers of these income tax authorities. On whom do they have jurisdiction? What type of powers they can exercise? What is the hierarchy between these people concerned? Is there a possibility of people joining together for the purpose of completing an assessment? So these are the powers available. Then we start the interaction between the assessee who has done the computation, who serves the income tax department, whose role is now defined. Authorities who are going to govern the assessees are also well defined. Then start the process of interacting by assessees filing a return of income. And then we have scrutiny notices and culminating into an assessment. And thereafter, we have the process of recovery thereafter or appeal to take the matter further. But therefore, the most critical portion, the whole purpose of the Income Tax Act is to ensure that people who have taxable income are properly assessed. Therefore, this becomes the most important function under the Income Tax Act. If this assessment is happening the way we want it to be done, we are all happy with it. If it doesn't happen the way we want it to be done, then we are into a process of litigation asking for certain changes in terms of what went wrong in our perception of the presentation of the state of affairs and what the department perceives to be the correct state of affairs. That gets into an interaction, and therefore one of the mechanisms of correcting what went wrong at the initial stage, at least from the department's point of view, is the aspect of reassessment. So if something in the department's perception, in their view, has not been properly done, certain income has escaped assessment, which legitimately ought to have been charged to tax, then department says, I will have the power to reassess you. And therefore, this is a power prescribed under the Income Tax Act for the benefit of revenue to reopen certain items concerned. When we talk about reopening, therefore, they are unsettling something that has been settled. Therefore, courts have come to the rescue of taxpayers concerned to say that if you want to unsettle something, you're going to go back into history of a person's presentation of his state of affairs. We have to comply with the law or the conditions stipulated under the law very, very strictly. So much so a power is given, but the courts have said that no, this power has to be scrupulously exercised within the realms of law that we are going to lay down. Otherwise, we will hold the action to be not appropriate. We will therefore quash that action concern. So the process of assessment and reassessment, therefore, form a very significant function or they represent a significant purpose of the Income Tax Act. And we are here today to discuss the process of assessment and reassessment. Chythanya is yet to join us because of the Karaga festival and there is a big jam across. He has not been able to move. What we have done actually, both of us, in the last 5 days now, discussed very meticulously in detail the provisions of assessment and reassessment. We have come to certain propositions. And we thought we'll make the session an interactive session. Interactive session that I will ask him and give an outline of the provisions concerned, ask him questions, and what we have discussed will come out as a response to all of us, for us to take it forward. Now, this becomes important for the reason that we have had changes in the Income Tax Act. The chairman was referring to the efficiency, transparency, and accountability. These were the 3 criteria laid down under 143, 3 capital A, 3B, and 3C. They wanted to remove the interface. They wanted to impart efficiency. They want to therefore make a statement where you can complete the entire process of assessment without there being a physical meeting or interaction with the tax department concerned. This was the power given under, and these were the criteria prescribed under 143, 3 capital A, 3B, and 3C. Why was this required? Because they were making a statement that we will empower the government to frame a scheme for e-assessment. A scheme was there. That means the parliament did not pass the law. It prescribed certain outline criteria within which the scheme had to be framed. And therefore, the scheme ought to have consisted of or couldn't have violated efficiency, transparency, accountability, and the criteria laid down in 3A, 3B, and 3C. We find these provisions of e-assessment across the Income Tax Act. There are about 19 provisions where e-assessment schemes have been visualized under the statute. Under some situations concerned, schemes are already in vogue. For example, we have the e-assessment in terms of penalty, e-penalty procedures already there. So there are 19 schemes available. We'll have an occasion to refer to some of this the propositions concerned. And these are all schemes which have been now the basis of which have been incorporated in the Income Tax Act. And the government can, on the basis of these guidelines given to them, form an appropriate scheme concern. So this was the scheme in place for assessment year 2021. 21-22, they said, no, we will bring the law itself into the statute. The scheme, therefore, was converted into a statute by incorporating 144 capital B. So what was the scheme originally? What was therefore a guideline given to the government through 143 3A, 3B, 3C was then converted into a provision of the statute itself. The legislature itself therefore said, this is the law we're going to pass in relation to e-assessment. When they did that, there is no requirement of therefore having a reference to the guidelines concerned, because the government itself said, I'm now passing the law. The legislature itself says I'm passing the law, and therefore the requirement of having the guidelines there was not essential, because this became a part of the statute itself. So it's extremely important for us to understand that what was a part of the scheme originally is now a part of the act itself. All other schemes are by virtue of the guidelines to be given. They are therefore not a part of the statute. They are some sort of delegated legislation. And therefore, you'll have a reference to the criteria concerned when you understand the scheme as framed by the government. But as far as 144 capital B is concerned, you will have to be very careful to say that this is a part of the statute itself now. Therefore, there is no reason or recourse that is mandatory as far as the criteria is concerned. Although we believe that because the guidelines and notifications given by the government over a period of time, when they had a transition done from the scheme into the act, the government has made it clear that all that we have notified, all the guidelines we have given, all the SOPs we have given under the erstwhile scheme will continue to remain valid and applicable for the purpose of the Income Tax Act under 144 capital B also, possibly therefore indicating the government's intention and wish that those criteria will be relevant for the purpose, or those criteria are important as far as 144 capital B is concerned. Now, this transition is important for us. Why is this transition important? For a number of reasons. We understand that there was a particular methodology under this scheme. This came down into 144 capital B for the first time into the statute. This 144 capital B has undergone further change by a new 144 capital B now. When you start looking at the three divisions of law, the scheme, and I'll call it as 144B version 1, and what is now available to us is 144 capital B version 2. When you look at this transition from the scheme to version 1 to version 2, we find that there are differences. And therefore, the question for us is, are these differences material? Are these differences, therefore, very substantial in nature? Would they be available to us as a matter of recourse, as a matter of support to challenge the final action of the assessing officer? So we have to be very careful and we have to be mindful, therefore, of two things. One, the entire transition from the scheme to version 1 to version 2. This is one part of the story. Second, we also have to be mindful of the fact that the 144 capital B, either version 1 or version 2, what is its interplay with various other sections of the Income Tax Act? What is the interplay? Because ultimately, who is going to do the assessment? A tax department. Who is the tax department who is empowered to do an assessment in my case? We'll have to go back to the various provisions under the statute concerned. Which are those provisions? Our interplay with those provisions will become very important. Therefore, our interplay would be with Section 120 of the Income Tax Act, Section 124 of the Income Tax Act, Section 127 of the Income Tax Act, Section 129 of the Income Tax Act. These are the provisions that are dealing with the jurisdiction and the powers conferred on the assessing officers. Who is the person who will have the power to assess you? Dealt with by 120. What is the jurisdiction over which he exercises the power? 124 will deal with that. What will happen when the assessing officer needs to transfer the file to another jurisdiction concerned? 127 will take care. What happens when somebody is assessing you and somebody replaces him? 129 takes care. It's important for us to understand the interplay between 144 capital B vis-a-vis this section is concerned. This is one segment and one area of law we have to be extremely careful about. One. Two, the existing scheme of the Act had various powers available to the tax department under respective provisions concerned. We have to therefore understand whether those provisions continue to hold the field or they get subsumed into 144B or they don't exist at all properly today. What are those provisions that we have to be mindful about? For example, under 142 capital A, assessing officer can give a direction for the purpose of getting the accounts audited by a person who is an auditor and appointed by the Commissioner of Income Tax. An audit can therefore be compelled upon an assessor concerned. So what will be the position in relation to those persons concerned? One. Two, we have provision relating to valuation of an asset concerned. 142 capital A. Who is the person who has the right to value? What will be the powers available with him? We have a 55 capital A available to us under the statute concern. So 55 capital A with 142 capital A read with the powers under the scheme to make a reference to a valuation officer or a verification unit or a technical unit for the purpose of valuing an asset concern. So what will happen to interplay between these provisions concern? Then we have the reference to 144 capital A, where the JCIT can have the suo motu power of calling for records and giving direction which are binding on the assessing officer concerned. What will happen to those provisions? Four, we have the transfer pricing officer concerned. He is a separate person concerned whom we are making a reference to for the purpose of finding out the arm's length price in an international transaction, and there are associated provisions of DRP and others. What will happen to those provisions vis-a-vis 144 capital B? What will happen to GAR provisions? At what stage, who can invoke the GAR provisions when you want to declare a particular arrangement entered into by the SSC as an impermissible avoidance arrangement? What will happen to reassessment provisions? How do they interplay? How do they pan out with the assessment provision of 144B? So we'll have to be mindful of these facets concerned. So various sections under the Income Tax Act and in their interplay with 144 capital B. Or interplay between this 144B. We have so many people who are involved with you. We have a person who is the assessing officer. We have a technical unit. We have a verification unit. We have the review unit. What will be the hierarchy? What will be the interplay between all of the sections concerned? And what will be the way in which the assessment process will have to be carried out? And what will be the way in which we could challenge that there have been certain deficiencies by the tax department in the course of compliance with the various conditions concerned? Along with that, juxtaposed with this, we'll have to therefore look into various notifications, various standard operating procedures that the board has laid out. These standard operating procedures are supposed to be mandatory on the tax department complying with this e-assessment. And therefore, although they may be going a little beyond what the law prescribes for us, it's important because they are now given to the tax department for the purpose of going about the way in which you have to conduct the assessment concern. It's important for us to look into these SOPs also and find out how do they have a seamless integration or they're contrary, and if they are contrary, has the department therefore slipped somewhere for us to take advantage of those lapses by the department concerned. So this process is going to be extremely important in terms of understanding the interplay between the various provisions of the Act, where in terms of powers and jurisdiction, in terms of other powers available, in terms of the inter se operations of the scheme or Act, and also the SOPs concerned. This is going to be, in our opinion, the nub of the discussion. Then we will go into certain other provisions between 144B. So the first part of the discussion will consist of reasonable discussion in depth with the technical analysis of 144 capital B. It's extremely important for us that this technical analysis is undertaken, that we are able to appreciate the role of 144 capital B and its interplay with various other sections of the Income Tax Act. Only then we'll be able to understand and appreciate that there are important provisions, there are important checks and balances in favor of an SSC. Therefore, if at all something goes wrong, he should take advantage of those checks and balances and slippages by the tax department for the purpose of protecting the interest of the client concerned. We'll therefore stop here. I'll have Chythanya to give his preliminary remarks, and then we'll begin the process of interaction. I'll ask him some questions and I'll respond to those questions. Khincha. Any preliminary remarks by Chythanya on the whole process? We'll proceed. Yeah.
Chaitanya sir has joined us. So I request our chairman to come on the dais and welcome Chaitanya sir with a floral bouquet. I'm handing over the technical sessions back to the speakers.
The first issue, therefore, we discuss is who is going to be the assessing officer of an assessee who is going to be assessed under the 144B scheme. This is important for the reason that if you look into the erstwhile 144 capital B, they made a statement that the National Faceless Assessment Center shall be the assessing officer. NFAC was the assessing officer. Now they made certain changes. They have made changes in the scheme under 144 capital B as currently designed. So it's important for us to understand who shall be my assessing officer concerned. And having understood who is your assessing officer, the corresponding adjunct questions would be, let us understand, I made a statement that we have to understand the interplay of the person who is an assessing officer vis-a-vis section 120 of the Income Tax Act, vis-a-vis 124 of the Income Tax Act, vis-a-vis 127 of the Income Tax Act, vis-a-vis 129 of the Income Tax Act. There's one more section, section 130 that has been introduced, saying that for the purpose of outlining the powers and jurisdiction or conferring certain powers on these people concerned, we will have a scheme, we have the power to frame a scheme for the purpose of 120, 124, 127 and 129. This is now enshrined in section 130 of the Income Tax Act. It's important for us to understand these provisions concerned, and who ultimately shall be your assessing officer, how many assessing officers do I have, and there are many assessing officers, what will be the role in which, or what will be the way in which the files will move between one officer concerned? Would there be some sort of a right I have? Would there be some sort of a benefit I have for certain procedures to be followed by the tax department concerned? Therefore, who is my assessing officer becomes a very critical question.
Let me apologize for Can you hear me? My sincere apologies for being delayed thanks to Karaga festival going on in the town. And I would thank the Bangalore branch for giving an opportunity to, rather to us, to spend good value time discussing some of these provisions. Now, taking Mr. Padam's question on who is your assessing officer. Very interestingly, under the Faceless assessment scheme, you would have multiple assessing officers at the same time who would have concurrent jurisdiction on you. To start with, you will have section 120, which will deal with conferment of jurisdiction by the board to the various income tax authorities down below. And 120 subsection 2 would delegate this power to give away jurisdiction to the principal commissioner, etc. Then you will have 120 subsection 4 clause B, which will talk about the special jurisdiction. In some very special cases, you will have the Joint Commission of Income Tax or Additional Commission of Income Tax acting as assessing officer. Otherwise, in terms of section 27A, assessing officer would mean the income tax officer or the assistant commissioner or the deputy commissioner. The joint commissioner, the additional commissioner could be assessing officer in terms of the special jurisdiction conferred under 120 subsection 4 clause B. You have section 120 subsection 5, which will talk about the concurrent jurisdiction, where several officers would have jurisdiction on you, several officers belonging to distinct ranks, superior, inferior. You will have a team of assessing officers assessing you, which would consist of joint commissioner at the helm of it, couple of deputy commissioners, 3-4 ITOs. In a big case like Reliance, it wouldn't be handled by one person. There would be a team of assessing officers who would have the concurrent jurisdiction. Then you will have section 120 subsection 3, which will give you parameters upon which basis the jurisdiction could be conferred. It could be the territorial area, it could be the assessee or the class of assessees, income or class of incomes, cases or classes of cases, on which basis the jurisdiction would be conferred. And section 124 would come in only where the area-wise jurisdiction is given. Otherwise, 124 would as such have no role to play. As I said earlier, under section 120 subsection 3, there are different parameters in respect of which the regard shall be had before the jurisdiction is conferred. It's only when the area-wise jurisdiction is conferred, 124 would come into play. Now, that means the person who would have jurisdiction on you would be in terms of the orders passed under section 120 on the basis of parameters given in subsection 3, read with section 124. So who is the guy who would have, this is the person who would have jurisdiction on you regularly. But you would have now the faceless assessment. Your assessment could go to assessment unit at another corner of this country. You wouldn't even know who the assessing officers constituted in the assessment unit. Therefore, what they've done is, they have amended section 120, they have brought in section 130, whereby they have said this conferment of jurisdiction under section 120, read with 124, will now also be done in a phaseless manner, whereby whichever assessment unit to which your assessment would go for that particular year, all the persons which are comprised in that assessment unit would also be your assessing officers. So it would work, in a seamless fashion. I'll give an illustration. Let us say Mr. Padam's return would now have to be assessed for a particular assessment year, going from 22-23 onwards. We're talking about 144B as amended by Finance Act of 2022, effective assessment year 22-23, effective 1/4/2022. Now, the assume that I am NFAC, I would, by automatic allocation process, which has its own algorithm and artificial intelligence in order to ensure the dynamic jurisdiction as well as the most efficient use of resources, it would, let us say, go to Arun, who is let's say Arun is an assessment unit. I would rather say, we'll rather take assessment unit of Hassan. In Hassan assessment unit, there are 4 officers. Now, as soon as the NFAC allocates Mr. Padam's return to Hassan's assessment unit in terms of section 130 of the Income Tax Act, some sort of a concurrent jurisdiction would immediately be conferred on the assessment unit, which is in Hassan. Alongside, in Chamrajpete, there is one assessing officer who has area-wise jurisdiction on him. In terms of section 120 read with 124, because his office is in Chamrajpete, there is one assessing officer on the basis of area-wise jurisdiction. Because his principal place of business is there, he would have jurisdiction on him. That would remain. In addition to that, instantaneously, as soon as his case is allotted to Hassan, in terms, that's under 144B, his case is allotted to Hassan. In terms of section 130, the jurisdiction would also be automatically conferred on Hassan. And therefore, you will have a situation of Chamrajpet officer having jurisdiction, Hassan unit having jurisdiction. Now, let us say Hassan unit would want some technical assistance in respect of Mr. Padam's return. Take, for example, some verification has to be done. Some, transfer pricing analysis will have to be done. Some property valuation will have to be done. Let's say valuation will have to be done. So it would request me for a valuation of his property. Now his property will have to be valued. His property will have to be valued means a reference to valuation will have to be made in terms of section 142 capital A, which also is made under Faceless scheme in terms of 142B. So instantaneously, the moment the requisition would come from Hassan assessment unit to NFAC, that is valuation will have to be done. Then what NFAC does, by an automated process in terms of section 142B, it will go to, say, Mysore unit for the purpose of valuation of his property. Now, Mysore unit is a technical unit. The moment it goes to Mysore unit, technical unit is also defined to be assessing officer. Instantaneously, there is a conferment of jurisdiction on technical unit in Mysore also in terms of section 130. So meaning now, who will have jurisdiction on him as assessing officers? Local Chamrajpete, Hassan, and the Mysore unit. All this would happen in a seamless process. Maximum use of technology is made. Law is enabled to provide for it. And let us say he has international transactions. His international transactions now will have to be evaluated in terms of instruction 3 of 2016. Assessment unit, assessing officer cannot examine. It has to be referred to the TPO. Now he needs, Hassan unit would need assistance in terms of evaluation of arm's length transactions entered into. A requisition would come to NFAC. NFAC through an automated process will allocate it to an assessment unit in, or rather a technical unit in Mumbai. The moment it is done, technical unit in Mumbai would have a jurisdiction conferred on it in terms of section 130, automatic. So now how many assessing officers will have on him? The Chamrajpete, Hassan, Mysore, and Mumbai. And how long will these jurisdictions remain and reside with respect to officers? They would remain and reside with respect to officers in terms of section 144B. As soon as his matter is handled, that case is done, then it would be a case of ceasing to have jurisdiction in respect of all these units, and only permanent guy is the Chamrajpet assessing officer who would have jurisdiction on him. Now, whenever the jurisdiction is conferred, usually the conferment of jurisdiction is defined in section 127, which deals with transfer of case. It talks about the case. So when a case is, you would have heard of transfer of jurisdiction. A search will take place. Then immediately what will they do? They move a case to central circle in terms of an order passed under section 127. You are in one place. You seem to have dealt with a series of companies which have interest in another place where a search would take place. Your assessment here would also be connected with the group assessment in another place. So 127 process would take place. Right. There the word case is defined as consisting of the concluded cases, the pending cases, and the cases which may be commenced thereafter. But then the word case is defined only for the limited purpose of 124 and 127, and it is not for the purpose of conferment of jurisdiction of 120. Therefore, the meaning, the expanded meaning of case, which will mean all lock, stock, and barrel, the matters would move. That would not move in this dynamic jurisdiction issue. Only what is related to that particular year would go. As soon as the assessment is over and the NFAC would then transmit all the records back to the Chamarajpet officer. All these other assessment units, the technical unit in Mysore, technical unit in Mumbai, the assessment unit in Hassan would cease to have jurisdiction. So this is how the jurisdiction issues handled in the Faceless assessment scheme. Have I answered your question?
It's important for us to note that the various type of offices concerned, we may possibly go on expanding by reading 144B. A review unit can come in for the review of the orders concerned. A request goes, NFAC, where therefore to make a reference to the review unit, that review unit also becomes the assessing officer. So the assessment unit, the technical unit, the verification unit, and the review unit can all become, and the officers concerned therein can all become your assessing officers. That's extremely important for us to understand. Now, it's important to understand now that this is a change that has been brought about by 144 capital B. And Chythanya also made a mention that all of the extraneous people concerned who are there, they cease to have jurisdiction once the case or the assessment is completed. This is extremely important. Now, two things are also important for us on this matter concerned. And therefore, we take this discussion a little forward. First is, who was the assessing officer for you under the erstwhile 144B? Who was that fellow? Is it the same fellow or somebody else who was the assessing officer under the NFAC? One. Two, we also have to understand that this process that is now enshrined in 144 capital B, which is enshrined today, would it apply only to those cases that are picked up for scrutiny now afresh? Or what happens to those cases where the matter has traveled to the tribunal? Tribunal would say, hey, do the assessment de novo. There are certain fundamental errors in the way in which you have gone ahead and completed the assessment. Therefore, it's an assessment of an earlier year when 144B was not there in the statute. But today the matter has traveled to the tribunal, and the tribunal then says, hey, look here, something has gone fundamentally wrong in the entire process. Some things have not been done properly. Let the assessment be done de novo. What will be the position concerned in relation to these type of assessments? Therefore, we have to understand the exact application of 144 capital B. Does it apply only to those assessments that are going to be done in terms of scrutiny after the current ongoing year, or would they also apply to those orders that have come from the tribunal or from any other authority concerned saying this matter has to be done de novo now? So who was the assessing officer earlier under 144 capital B or under the scheme that was originally framed? How is there a transition in understanding of the role of an assessing officer?
(144B) subsection 2 would determine the cases that would get covered by the Faceless assessment scheme. If you would look at various notifications or the orders or the instructions passed under 144B2 over a period of, about 1+ year, the board has notified that except Central Circle, except the international circle, not the transfer pricing, international circle, the foreign companies, who get assessed, non-residents will get assessed. Then you will have, some situations of pendency being created in ITBA because of technical reason or the cases not having permanent account number. Except these cases, all other cases, including section 147, will have to be carried out through Faceless scheme. Meaning 144B2 is a negative list. If you have a doubt as to whether your case gets covered under 144B1 as Faceless or not, the only thing you need to do is to see whether your case is in the small negative list of 4-5 cases. If it is not in that list, that means your case will have to be handled through the Faceless assessment. Now, let us say there is an order against which I am aggrieved. I have filed an appeal. The appellate order has come. So there could be 3 types of appellate orders. One is a case of dismissal. Then, of course, what I will do? I will go in further appeal. 2 could be a case of allowing the appeal with, specific directions. It is not a de novo remand. It is like order giving effect to So order giving effect to is covered by section 153(5). The assessing officer has to pass an order giving effect to the appellate orders within the time frame given in 153(5). Under section 144B, subsection 1, the last clause, if you would see, after the assessment order is passed, NFAC will have to send all the records back to, in our earlier example, Chamarajpeta assessing officer who would have area-wise jurisdiction. Then he would have gone in appeal. The appellate order would have come with, certain directions which will have to be now given effect to. And who would have to do it? It is not the case of passing an assessment order. It is not an assessment. It's an order giving effect to an appellate order. That would be done under 153(5), and that would be done manually, not through the faceless. This is one situation. Take another situation where the third possibility, when the matter is taken up in appeal, is they may make a remand for a de novo assessment. When an assessment order is set aside for various reasons, for example, 144B1 procedures are mandatory procedures. Like, for example, if your case is to be handled under faceless, in terms of clause 2, you have to get an intimation that your case is being handled under faceless scheme. In the absence of intimation, you could possibly challenge the very faceless assessment, in which case what would happen is they will rather remand it back with the direction to follow the procedure. Under 144B version 2, which has come after 2022, they'll have to prepare something called ILDP, Income Loss Determination Proposal. There is no concept of draft order except in the case of an eligible assessee now, unlike in the case of 144B version 1. So an ILDP will have to come, and you will have to be given a show cause notice in respect of variation which are prejudicial to you. And if you are not been given adequate time to respond, they would have sent you a notice yesterday asking you to furnish your data and upload the reply by today, and which you have sought time, which time is refused, in which case it is a case of breach of principle of natural justice, and the appellate form would have said, okay, the whole lot will have to be sent back for being done de novo, in which case, whether the de novo case is covered in that negative list of exceptions is what has to be determined. The answer is no. So de novo case is not in the negative list of exceptions given in 144B2, meaning it has to be invariably done under faceless. And who has to do it again? As I said earlier, if it were a case of 153(5), Chamarajpeta officer would have done it. If it's a case of de novo, then it has to be allotted by an automated allocation process by NFAC. It could be to Hassan assessment unit, it could be to Mysore assessment unit, it could be to Ahmedabad assessment unit. It could go to any assessment unit without the human intervention. And then he would have concurrent jurisdiction along with Chamarajpeta on him. Is that part?
It's also important for us to note a couple of things, therefore, from this discussion, it's important for us to note that there was some sort of an existing scheme under the Income Tax Act of all authorities across the country concerned. They have picked up some of these officers concerned and now made them a part of the NFAC. We are also the regional assessment centers. The regional assessment center concept no longer is valid today. It's NFAC only. Now, therefore, some officers have been picked up to constitute the NFAC. Along with NFAC, all the units concerned. So this is called as the NFAC, and the balance is called as the residuary jurisdiction or residuary unit concerned. So whoever the Chamarajpeta officer that Chythanya mentioned in the example, he will be the residual assessing officer concerned. Now he also is making a mention about the appeal process giving effect to. That will be the job of who? The residual officer concerned. There's the board circular which says what shall be the job of the residual assessing officer. Because as Chythanya rightly mentioned, after the assessment job is over, this process of assessment is done, everything will be pushed back to the residual assessing officer. So his job is something goes wrong tomorrow, rectification has to be done. It will be the residual assessing officer concerned. All the assessment is made by assessment unit. Rectification application by virtue of the board circular will have to be done by the residual officer concerned. Demand collection will have to be done by the residual officer concerned. Record keeping, residual officer. Order giving effect to or giving effect to the orders of appellate authorities, residual assessing officer. Infrastructure management, residual assessing officer. So the assessment fellow there would have finished his job, and the consequence of that all will have to be handled and managed by the residual jurisdiction itself. And therefore, there is an important role for him to play because he has to carry into effect all that has happened between the technical review assessment units concerned. This is important for us to understand, and it's also important for us to understand that this type of jurisdiction between all the units concerned, all the people manning there are your assessing officers, was not the concept because NFSC was the assessing officer concerned under the erstwhile regime, under the version 1 and under the scheme. It was the NFAC who was the assessing officer, and this is a very significant difference. Under version 2 now, all the persons concerned in the units are going to be regarded as assessing officers concerned. And therefore, as Chythanya said, their jurisdiction ceases moment the assessment job is over, and therefore, next year, when my case is picked up for scrutiny and it goes to another assessment unit because a recommendation is made to NFAC and NFAC assigned that to somebody else, it's not a question of a new assessment unit having jurisdiction over me, and there's no need of, therefore, looking at an order under 127, that assessment unit fellow in Hassan now is going to be handled by Guwahati person concerned. That type of 127 order is not required. It's only when my jurisdiction moves from Chamarajpet office to some other officer concerned, then 127 requirement will require it to be satisfied. That's extremely important for us to understand, therefore, that who shall be the assessing officer, what the roles are, what the jurisdictions are, and what is the time limit or the action for which that jurisdiction has been temporarily conferred. It's extremely important. Now, having understood that there are many assessing officers concerned, let us understand that what is that 144B has provided for us vis-a-vis what the respective sessions provide for us. I'll begin with one explicit provision made in 144 capital B. And with this, we'll understand what is explicitly provided for. And then in the light of what has been explicitly provided for, we will find out the interplay with other provisions where there is no conscious or explicit breach that has been created between those respective provisions and 144B. What is it that we have now expressly providing for under 144 capital B is an audit that is required to be conducted under 142 2 capital A, where there's because of complexity of accounts, interest of revenue, frequency of transaction, so many things that can happen, where the assessing officer wants the accounts to be audited. He may make a request under the erstwhile law to his commissioner concerned to say, get the accounts audited by a special auditor whom the commissioner were to appoint. These are the provisions conferred under 142 2 capital A. Now, under 144 capital B, there is an explicit provision made as to how to go about this request from an assessing officer to get the accounts audited, which is the process under 142 2 capital A. There has been an explicit mention made in 144 capital B scheme. So, therefore, for us to understand what is it that has been explicitly mentioned in 144 capital B in relation to these type of audits concerned, what is it they have now said how to go about this process concerned. Having understood this explicit provision, then we will try and broach upon certain other provisions where this explicit bridge is not built into those connected provisions and 144 capital. Therefore, let us understand for the time being 144 capital B vis-a-vis the audit conditions under 142 2 capital.
You have known about the special audit, which the assessing officer, with the previous permission of the previous approval of the principal commissioner, may order under section 142 within brackets 2 capital A. The various parameters like the nature and complexity of accounts, volume of accounts, doubts about correctness of accounts, multiplicity of transactions in the accounts, a specialized nature of business activity of the assessee, and the interests of the revenue. These provisions are contained presently in physical form under 142 2A, 2B, 2C, 2D. Now, this also is made faceless in terms of section 142B. So, there is a difference between 142 2 capital A, 142 open brackets 2 capital A, which will deal with the special audit. Now, this special audit under 142 2 capital A is now made faceless in terms of 142 capital B, called faceless inquiry or valuation. This would deal with what situations? It would deal with issue of notice under 142.1. Even issue of notice under 142.1 could be faceless. 142.1 notice could be issued for what purposes? If you're not filed a return, asking you to file a return. If you filed a return, asking you certain information. That could also be made faceless, as it's already ingrained into 144B, because 144B talks about assessment unit being empowered to issue notice under 142.1 as well. And even 142.2 capital A of special audit is also brought into faceless inquiry or valuation under 142B. This part has to be noted. And a scheme has already been brought in, which scheme says that this allotment of audit under 142.2A will have to be done faceless under 142B to the extent compatible with the faceless assessment under 144 capital B. So that is how they are interconnected. The requirement under 142 within brackets 2 capital A and 142 continuous capital B in as much as making it at faceless. And now under 144B subsection 1 clause 32, which is a replica of what you have found in 142 within brackets 2 capital A, various parameters. The very same parameters like nature and complexity of books of accounts, etc., which are brought into in 142.2 capital A are replicated in 144B subsection 1 clause 32. Now, we'll continue the same example for the sake of, our consistency in understanding. His case is presently with Chamrajpete, the jurisdictional assessing officer, has gone to Hassan assessment unit. Hassan assessment unit is defined under 144B subsection 3 clause 2 as assessing officer. As I've said, he would have concurrent jurisdiction on him. In the course of assessment, he would find because of these many parameters as are listed in clause 32 that it is a case for invocation of 142.2A. So assessment unit will feel that it's a case that has to be taken under 142.2A. So what it does, it would then intimate the NFAC. Yes, this case requires a special audit under 142.2 capital A. An intimation comes to NFAC. The moment the intimation comes to NFAC, NFAC will have to deal with this in the manner provided in subsection 7 of 144B. So what does subsection 7 say? It says the principal commissioner in charge of NFAC. See, NFAC is headed by the principal chief commissioner. The principal chief commissioner, the principal, the director general in charge of NFAC, if he considers that yes, the proposal sent by Hassan unit for 142.2A requires consideration, what it may do, it may forward the reference of the same to the principal chief commissioner who would have jurisdiction over the Chamrajpete. And if it is so done, his assessment will be taken away from the faceless and physically moved to Chamrajpete. I'll repeat again. If the assessment unit in Hassan considers that it's a fit case for 142.2A, it cannot directly deal with its principal commissioner and go and appoint a special auditor under 142.2A. It cannot pass such order. It can only send a proposal. That proposal will come to NFAC. Then the chief of NFAC will consider, oh, this proposal, is it worth the consideration? If he so considers it, then he will send it to whom? The principal chief commissioner who would have jurisdiction over Chamrajpete officer, who in turn has jurisdiction over Mr. Padam. This is one case. Just keep it on hold for a while. If the NFAC head considers that no, it is not a fit case for 142.2A, he need not even forward it to the principal chief commissioner, in which case Hassan assessment unit will have to proceed with the assessment without recourse to 142.2A audit. Have you understood? So simpler thing first. The principal chief commissioner of the NFAC considers that it is not a fit case for 142.2A, in which case it will not forward it and it will intimate the Hassan unit nothing to do with the special audit. Please proceed with your normal assessment. Then Hasan unit has no choice but to proceed with the assessment without the aid of special audit. Now, if on the other hand, as I said earlier, the principal chief commissioner of the NFAC considers that the proposal is a fit case to be taken into consideration, and then he will forward it to whom? The principal chief commissioner, who would have jurisdiction over the Chamarajpet assessing officer, who has area-wise jurisdiction on Mr. Padam. Then immediately the case is withdrawn from Hasan assessment unit and would come to Chamarajpet. Then what will the principal chief commissioner do of Chamarajpet? He would then direct. He has a mandate to direct. He cannot then decide. He has a mandate to direct the Chamarajpet assessing officer to invoke the provisions of 142(2)(a). To invoke the provisions, not to go ahead and straight away refer a special audit, to go and to invoke. Invoke means Chamarajpet assessing officer will start afresh at 142(2)(a, will re-examine these parameters which are given in 142(2)(a as I've just read out, which are replicated in clause 32, and decide whether it's a fit case. If he considers it's a fit case, he has to then take the prior approval of the principal chief commissioner, that is his superior, in spite of the fact that it is the very same principal chief commissioner who would have asked him to invoke the provisions of 142(2)(a. So asking him to invoke the provisions of 142(2)(a is not the same as giving prior approval for actually appointing special auditor. Then what would happen? The Chamarajpet officer would consider whether it's a fit case or not. If he considers that it is a fit case for special audit, he would then take the prior approval of his boss. Then an auditor would be appointed who would then visit his premises, will conduct the audit, and the assessment would be done physically. Now, an interesting follow-up question is, if the Chamarajpet assessing officer, upon examination of 142(2)(a all over again, considers that it is not a fit case for special audit, will it bounce back to the, like Faceless? There is no such provision here. Once the proposal is moving from principal chief commissioner of NFAC to the principal chief commissioner who has jurisdiction over assessment unit, and the case is taken away from the assessment unit, and case would move to Chamarajpet unit, irrespective of the outcome of the decision of the assessing officer as to whether a special audit will have to be taken or not. He may not decide to go for special audit, or he may want to go for special audit, but then Chamarajpet principal chief commissioner may not approve it. No prior approval will be obtained. Then even in that case, despite the fact that it has in the end resulted in no special audit, it would not move back to Faceless. It will have to be handled by Chamarajpet assessing officer, because there is no provision for hop in and hop out between physical and the Faceless.
Very intricate movements. We need to add to this the internal timelines that the board has prescribed for the review unit, technical unit, by what time they should respond, in what manner they should respond, and by what time they should give the response back. What should be the internal timelines between the various units concerned? Extremely important for us to be mindful of this. We're not discussing the internal time limits for the time being, because we need to understand the interplay. So one more facet of it, therefore, would be the aspect of transfer pricing. We have discussed briefly initially as to what happens when a transfer pricing issue is involved, because very interestingly, the assessment unit, that is the Hasan unit in the example we are discussing, may take the assistance of whom? May take the assistance of a technical unit. Technical unit is what? A unit that has to facilitate the conduct of assessment, and it's supposed to be it has to give you assistance and advice on various matters, including valuation, including transfer pricing. So one of the areas explicitly mentioned in relation to which the technical unit has jurisdiction, where it is required to confer assistance or confer to give advice, is matter of transfer pricing. Therefore, we'll take the aspect of transfer pricing. It goes to the assessment unit. What should the assessment unit do now when it wants to do a transfer pricing analysis, determining the arm's length price of the international transaction that the CC has entered into? What should be the process concerned? Because we now have assessment unit, then go to the technical unit. From technical unit that has the expert advice, so to say, on transfer pricing matters, what is it that is expected of the interplay between the technical unit, assessment unit, and what is the role of a transfer pricing officer? Does he have a role at all to play now? Because technical unit is supposed to have the expertise in transfer pricing matters. Are you giving a go-by to transfer pricing officer to say, no, yeah, that man is now, the transfer technical unit is now having the capability, supposed to have the capability of transfer pricing matters. You have no role to play under the Income Tax Act. You are now a dead letter. Is that the way it should be? Or the transfer pricing officer still has a role to play, because this can give rise to a ramification in terms of the eligible assessee, the procedure of DRP, and the procedure in relation to the draft order and the consequential directions given and the appeal process thereafter. It's extremely important for us, therefore, to understand the transfer pricing nuances and the way in which 144B, read with the associated provisions, will help us in culminating the transfer pricing exercise in relation to international transactions of an assessee.
Yeah, this is an extremely important and I would say one of the most complex questions. See, we have several parallel and repugnant provisions in the Income Tax Act, repugnant to 144B. If you look at 144B subsection 1, and if you look at the language of 144B subsection 1, it starts with a non-obstante clause. Notwithstanding anything to the contrary contained in any other provisions of this act. Meaning what? If there is no conflict, no difficulty, 144B will have to be followed. Now, if there is any provision in the act which is repugnant to the procedure prescribed under 144B1, so which would have a preference in terms of 144B1, because it has a non-obstante clause, 144B1 would override all other contrary provisions. In other words, all other contrary provisions will have to yield to 144B1. This has to be always kept in mind. Point number one. Point number two, take the case of transfer pricing. There are international transactions entered into. Form 3CB is filed. It will get filed, it will get e-filed. Then, under 92, it's the suo motu obligation of the assessee to determine his international transaction in income in respect of international transactions having regard to arm's length price. Under section 92, subsection C, 92C subsection 1, the assessing officer can, in certain circumstances, interfere with the determination of ALP by the assessee. So who has the power from the department to interfere with the determination of ALP? Principally, it is the assessing officer. Right? Who determines the ALP? The assessing officer. But then you go to 92CA subsection 1, which says, where in the course of an assessment proceeding, if the assessing officer considers it necessary or expedient, then for the purpose of determination of arm's length price, he may, with the prior approval of the principal commissioner, refer it to the transfer pricing officer. And from there, the transfer pricing officer will take the jurisdiction. If you would look at the language of 92CA1, whether to refer or not to the TPO is the choice of the assessing officer. So in a given case, if he does not choose to refer it to the TPO, he himself could exercise the power under 92C1 is one understanding. Now this understanding is interfered by the board instruction 3 of 2016, which has not been, to my knowledge, withdrawn as yet, which instruction says that if the assessment is picked up for scrutiny under CASS, on a TP risk parameter, it has to be invariably referred to TPO. It is not the choice of assessing officer. It has to be invariably referred to the TPO. This is to standardize and remove the discretion and arbitrariness from the point of view of AO, deciding in some cases to do it himself, in some cases not doing it himself, and also considering the fact that AO in a given case may not have the technical expertise of determination of ALP like what the transfer pricing wing ought to have, or is expected to have, whether or not they have it. And this instruction says that if it is picked on TP risk parameter, whether by CISS or manually, but on the TP risk parameter, it has to be invariably referred to the TPO, number one. If it is not picked on the basis of TP risk parameters, but the AO will come across the international transactions entered into but not reported, certification under 92CC is not filed under form, which form? Form 3CB is not filed, and in which case also he has to invariably refer it to the TPO. Or in another situation where the preceding previous year's TP is disturbed, where more than 10 crore ALP is determined, then he has to invariably refer it to TPO. Or if the preceding year's TP order is set aside, then he has to invariably refer it to TPO. So in all these cases, he may have to invariably refer it to TPO. But there could be a very, very few cases where no such reference is called for. The case is picked up for a non-TP risk parameter, but there are international transactions which are not required to be referred to. Even in those cases, the AO is not expected to determine the ALP. He has to accept it at ALP with a note that he has not even examined it. Are you clear? That means, as per the board instruction as it stands today, to the best of my knowledge, under no circumstances, AO can determine arm's length price. There are only two situations for him. Either send it to TPO in the given cases, or don't do anything in the rest of the cases. He can't himself determine the ALP. Now, this being the position, let's see how it works in faceless situation. If you look at faceless scheme, if you would go to 144B, clause 4, where a case is assigned to the assessment unit under clause 1, assessment unit may make a request through NFAC for, look at three things. Look at clause C there, seeking technical assistance in respect of determination of arm's length price, valuation of property, withdrawal of registration, etc. Now so look at the technical assistance here. Assessment unit may seek technical assistance in respect of determination of ALP. It is not mandatory, but then you will have to keep in mind the board instruction 3 of 2016 that in the given situation, it has to necessarily seek. It cannot itself determine the arm's length price. Now, once it so seeks the assistance of the technical unit for determination of ALP, then where the request is so received by NFAC, what NFAC will have to do? It will have to send it to a technical unit by an automated allocation process. In my earlier example, it has gone to Bombay unit. For determination of ALP of the international transactions entered into by him, a requisition has come from the Hassan unit to NFAC seeking assistance on the basis of instruction 3 of 2016 that these transactions will have to be subjected to an TP audit by the transfer pricing officer. So the NFAC will then transmit it to, the technical unit in Mumbai. Now, what is the definition of technical unit? This is extremely important. If you go to 144B3, clause 4, it says, such technical unit as it may necessary to facilitate the conduct of faceless assessment, to perform the function of providing technical assistance, which includes any assistance or advice on legal, accounting, forensic, IT, valuation, transfer pricing. Now, the ending words are extremely critical here. The term technical unit, hear me carefully, the term technical unit, wherever used in this section 144B, shall refer to an assessing officer having powers so assigned by the board. Now you would recall, why did I earlier say, the first question which Mr. Padam asked me about the jurisdiction, I told you that the moment it goes to the technical unit in Mumbai technical unit also will be the assessing officer. This is on the basis of the ending words of the definition of technical unit, which for the sake of clarity, I'll repeat again. The term technical unit, wherever used in this section, shall refer to an assessing officer having powers so assigned by the board. So that means the technical unit in Mumbai is also an assessing officer. Now, what is the technical unit expected to do? it is expected to assist assessment unit in determination of ALP as per the request of the assessment unit. Now what it has to do? Should it carry out it by itself? Should it carry out it by itself? If you look at instruction, because technical unit is also assessing officer now. Technical unit is also assessing officer. If you look at instruction 3 of 2016, it says assessing officer should under no circumstances determine ALP. He has to refer it to whom? The TPO. Now, if you would reconcile all this, it looks like the technical unit in Mumbai, which is the assessing officer, will now have to make a reference to the TPO. The reference to TPO under 92 CA will also have to be phaseless, because that it is also planned to be made phaseless, but no scheme has been notified as yet. So that means what? As you have seen, as you have encountered the transfer pricing audits from the department, they are all manual, right? They are not through phaseless. So it looks like now, post 1/4/2022, the technical unit in Mumbai would have to make a reference to the TPO. Then the reference to TPO would be made, a TPO will be appointed. Which TPO either could be phaseless if a phaseless scheme comes, or will have to be physical till the scheme comes. Because the scheme has not come in as yet, it has to be physical. So because he is in Bangalore, it's very likely that it will come to the TPO in Bangalore. But TPO is not the assessing officer, as you would know. So what does TPO do? He will interact with Mr. Padam, examine his international transactions, and would determine the ALP and furnish the report to Bombay Technical Unit. So once the Bombay Technical Unit obtains this transfer pricing report, it will transmit it to NFAC. And what then NFAC does? NFAC will send it to Hassan Unit. Then assessing officer of Hassan Unit would have to pass the assessment order in conformity with the TP order in terms of section 92 CA4. So is this clear? Now, there is an SOP on technical unit issued by the CBDT under 143(3)(b, which no longer exists now. But then they've issued an order on 31st of March of 2021 that all the SOPs, all the directions, all the circulars issued under erstwhile phaseless scheme. See, earlier, as you would know, it was a phaseless scheme under 143(3)(a). So whatever SOPs issued under 143(3)(a) would mutatis mutandis apply to the phaseless assessment done under 144(b). So in that SOP, which is issued with the in the specific context of technical unit, they have said that wherever a requisition comes to technical unit for assistance in TP matters, technical unit will have to refer it to the TPO. So now it is all falling in place, because who can refer any work to TPO? Under 92 CA1, who can make a reference to TPO? Only assessing officer. So unless the technical unit is also made the assessing officer, any reference by technical unit would have been bad. So we were earlier wondering, when this 144(b) version 2 came, and the defined technical unit also assessing officer, verification unit also assessing officer, review unit also assessing officer, we're wondering what is it they're trying to do? How many assessing officers will we have? Now we realize that if the technical unit is not made the assessing officer, reference by technical unit to TPO would have been bad in terms of 92 CA1. That's the reason why they have made technical unit also as the assessing officer. Now, once it goes to TPO, then he would proceed under 92 CA. Keeping in mind the provisions of 92C, he would then go ahead and pass the transfer pricing order, and which transfer pricing order would eventually reach Hassan Assessment Unit through NFAC. Then the Hassan Assessment Unit would prepare a income and loss determination, ILDP, income and loss determination proposal. Show cause notice would come. He would then reply to show cause notice, and then On that basis, Hasan unit will prepare a draft order, would send it to NFAC, Now, because he is an eligible assessee in terms of 144C, subsection 15, clause B, right? He cannot go ahead and pass the assessment order directly. So what then the NFAC would direct Hasan unit, don't do anything, just pass a draft assessment order. Don't pass the final order. Why he cannot pass the final order? Because he's an eligible assessee. When he's an eligible assessee, when there is a variation to his total income made by the transfer pricing officer in terms of 92 CA. So because he's an eligible assessee, in terms of 144C1, only a draft order in the first instance will have to be made, not a final order. So what the NFAC will direct him to do, pass only draft order. So what will be served on him is only the draft order. Then what will he do with the draft order? He has a choice to go to CIT appeal, in which case he does not do anything, or he will then go to DRP, in which case, the matter then goes to DRP. So then what has to be done is provided by 144B1 thereafter. If he is not an eligible assessee, of course, the question of transfer pricing would not arise.
This can get complicated. We have seen now the interplay, but it's extremely important for us to understand the technicalities associated with this. And what we're discussing are the basic technicalities. Taking this discussion forward, we can create some more complication. I'll just give an illustration. I don't think it's need for us to go into that illustration concern. But it's extremely important that when we are looking at the procedure being adopted through 144 capital B, an allocation referred to a specific question a little later, as to what happens when an assessment is not done in accordance with 144 capital E. What happens? What happens as a consequence of an assessment not being done in accordance with the proposal? That becomes the critical question. So why are you discussing all of this? Is it very casual to say if there are defaults, if there are certain non-compliances? Would it therefore go to the root of the validity of the assessment order, or they are excusable? That becomes very critical. And therefore, keeping that process in mind, keeping that objective in mind, is extremely important for us to look into the technicalities involved. We may find a little difficult in terms of understanding for the first time now what Mr. Chythanya has said. But then we should get a feel of what provisions we have to look for and how do you go about interpreting these provisions concerned. Take the case, I'll just give an example of complications. Take the case of the entire process from Hasan unit going to Bombay Technical Unit, going to the TPO, coming back to Bombay, going to NFAC, going to Hasan Technical Unit. He prepares the income and ILDP, income loss determination proposal. And that's what he sent it to NFAC. NFAC says, this order is not being done well, I can send it for a review. Now, can it happen in case of a transfer pricing order? Because the review unit also is an assessing officer only. He is not something superior. He is also an assessing officer only. Can an assessing officer, therefore, sit in judgment over the TPO? Because he has to follow the order in conformity, pass an order, he is subject to the TPO's order. So now the question arises, although there is a provision 144B for a review of this provision concerned, what should be the process therefore involved? One is that the review officer also is an assessing officer, one. Two, there is always an avenue available. Something is not being done properly. Then there is a process of eligible assessee, DRP or DRP will take care. DRP will take care of the deficiencies concerned, and therefore the board should not be therefore concerned with the deficiencies. And most importantly, this may not be right now occasion to discuss because it may be possibly a little premature because the review direction from NFAC will have to be in accordance with the board guidelines. We have yet to receive board guidelines on this matter. So the review guidelines will come in accordance with the board guidelines. This will become a fit topic when the board issues the criteria for the purpose of what circumstances should exist for the draft order or the ILDP to be going for a review concern. But then taking this matter forward, this becomes extremely important for us to understand the interplay between various provisions concerned and look at the infirmities in the entire process concerned for us to have a matter to challenge the entire process tomorrow being adopted by the various units concerned. So it's extremely important. The order is moving from all across, moving all across the person concerned, it's moving across so many officers concerned. So what is the process, what is the hierarchy, what is the timeline, how do you go about it, becomes, in my opinion, little complicated, but becomes a fascinating study, and it's necessary upon us to understand these niceties before we take the matter in challenge tomorrow. We have just discussed what? We have discussed the first question of the transfer pricing. Before that, we discussed the aspect of the special audit. Third issue now, therefore, we discussed briefly valuation officer concern. Again, a very interesting provision, because valuation is something that is explicitly mentioned as the subject matter of a technical unit under 144B, subclause 4, C subclause 4. Now, we also have 142 capital A coming in. We also have 55 capital A of the Income Tax Act. So, multiple provisions are in existence. 55 capital A has quite serious in terms of rights of an assessee concerned. The method of challenge is also there in 55 capital A. Those type of challenges are not available to us in 142 capital A. And we also have 142 capital B, which talks about a faceless process in relation to valuation of a property concern. And when you look at 142B, which says that valuation has to be faceless. Take the case of the example you're discussing, a property of mine has to be now subject matter of valuation concern. How do you expect the valuation officer to conduct this in a faceless manner without examining the property, without coming to me, without asking me the details and going to the property concern? Because now you are visualizing 142B to say that this valuation exercise has to be faceless. This was very interesting. Therefore, some comments from Chythanya on the valuation aspect concern.
Firstly, let us understand what are the valuation provisions which are available. As Mr. Padam mentioned, you have section 55 capital A, which will deal with the determination of fair market value for various purposes, but limited to the computation of capital gains. Provisions of 55A cannot be used for any other purpose except for capital gains purpose. Whereas you will have 142 capital A is an omnibus provision. It could be used for any purpose. Like, take the case of 43CA, an immobile property held as inventory, sold for a consideration, not matching with the guidance value, and you would put up a claim saying that the fair market value is less than the guidance value, and hence a reference to valuation will have to be made of an immobile property in terms of 43CA. That happens in the course of computation of profits and gains of business or profession. Whereas parallelly and conversely, if it is a case of an immobile property held as a capital asset, 50C will come in, where the guidance value will be benchmarked to the actual consideration, and as an assessee you put up a claim saying that the fair market value is actually less than the guidance value. So guidance value should not be imposed on, in which case what the AO has to do is to make a reference to valuation officer. Look at same immobile property, in one case held as inventory where section 55A may not apply. Held as capital asset, 55A would apply. Right? Now we'll have 142A, an omnibus valuation of any property, including immobile property, irrespective of which head of income it is to be computed. Now, before even you go to faceless assessment, first we have to understand which will have to yield to what, and ultimately which is the provision which the AO will have to apply. Should you apply 142A on the premise that this is the latest legislative will? Because when they brought in 142 capital A, they had 55A in place, they had 43CA in place, they had 50C in place. Should they just go by 142 capital A? But if you were to go by 142 capital A, and which 142 capital A valuation is now made faceless in terms of 142B, and the scheme also has been brought in to say that in accordance with, to the extent of 144B. In accordance with and to the extent of 144B, this also will be done faceless. And an immobile property which has valuation cannot be determined except when you physically visit. So you will have to visit, you will have to see the materials used, you will have to see the adjacent properties, you'll have to see what other properties are there, what kind of location is it. Not that it cannot be virtually seen. It could even be virtually seen, but then it's appropriate that it has to be physically verified. So first question we have to address is which provision will yield to which provision. Can we say that 142A is a general provision, 55A is a special provision, and applying generalia specialibus non-derogant principle, the general provision will yield to special provision, and therefore 55A, wherever it is referred to, will hold good. In which case 142 capital A would not apply. If that were the situation, in the Faceless scheme, if Hassan unit would want his property to be evaluated, if it is a case covered by 55A, wherever there is a reference, so 55A could be directly referred here, it could even be referred to in 50C, it could maybe referred to in 43C as well in a given case, because 43C in turn refers to 50C, 50C in turn refers to 55A. And there they refer to Wealth Tax Act, valuation officer appointed under section 16A of the Wealth Tax Act, and the valuation process to be adopted by him, and if he's not happy with the valuation, he can go in appeal, and the valuation officer's value will be binding on the assessing officer if it is a case of 55A. But if it is a case of 142 capital A, it is not binding on the assessing officer. Whatever valuation which is done by the assessing officer, after giving notice, he may consider it. It's the absolute choice of the assessing officer if it comes under 142A. So you look at now implications. If a case is covered by 55A, valuation is binding. Against the valuation officer, officer's order, you have a right of appeal. Whereas against 142 capital A order, you don't have a right of appeal. You have to appeal only like your transfer pricing order. Do you have a right of appeal for TPO's order? No. You appeal through the assessment order. So if it's a case of 142A, we'll have to appeal through the assessment order. And the valuation made under 142A is not binding on the assessing officer. Now, coming back to this, our understanding is that if you apply the principle of generalia specialibus non-derogant, the cases which are specifically covered by 55A, where there's a special right given to the assessee, special procedure made where a reference to valuation officer will have to be done, and references are made to Wealth Tax Act, those provisions will hold good. Now, I mentioned to you a little ago, 144B subsection 1 has a non-obstante clause. So notwithstanding anything to the contrary contained in any other provisions of this act. So it is not that it will simply override. There has to be something contrary. Nothing in section 55A which is contrary to 144B. Therefore, 55A will continue to hold good. So in all the cases where there is a specific reference to 55A, in our opinion, 55A would hold good. And there is nothing in 55A which is repugnant to 144B. Now, let us take a situation that it is a case covered by 55A. What does Hassan unit have to do? It has to be subjected to evaluation. What does Hassan unit have to do? Hassan unit will have to requisition NFAC. I need the valuation of this property which is covered by 55A. So what NFAC does? It will send it to Bombay Technical Unit. Technical Unit also is an assessing officer. So what Bombay Technical Unit does? It will then appoint a valuation officer in Bangalore or somewhere in Bangalore, like how in my earlier example, it would have made a reference to TPO in Bangalore. Like how TPA assessment is done physically, this evaluation also is done physically in terms of 55A. So this is applicable in cases covered specifically by 55A. Now look at the cases which are not specifically covered by 55A. See, valuation need not be only of immovable property. There could be angel tax liability, like put on him 5627B, in which case the unjustified premium will have to be subjected to tax. Valuation of that also may have to be done, but that is not covered by 55A because it is for the purpose of 5627B. So it may be covered under 142A read with 142B, in which case the valuation could be done by anybody. So that is a case where it could be done in a faceless mechanism, whereas the cases which are specifically covered under 55A will have to be covered under the physical mechanism, but the routing is like how we discussed the transfer pricing, how the TPO is appointed. In the same manner, the valuation officer reference also will have to be made.
This is not the end of the interplay. We have many more areas. I'll give two more samples now. And extremely important. We need to be aware of what we are dealing with. I made a mention, the most important function under the Income Tax Act is the function of assessment. We are here existing only for the assessment to be completed. And therefore, we have to understand the way in which the law is going to be operating tomorrow, henceforth, when we have 144B being invoked, and find out the interplay with various other sections. We will not go in great detail. Therefore, two small sections, because we're coming to the end of the first session. We will have equal amount of provisions in relation to reassessment, quite intricate. Here are more procedural provisions which we are discussing. In 147, we will have more of technical issues being discussed, more on the provisions, substantive provisions of law. Today we're discussing something more procedural, but extremely important for us to understand these procedural nuances also. So two things, therefore, that remain for us would be the ability or the power of the Joint Commissioner of Income Tax under 144 capital A that can call for any file, records, and give instructions to the assessing officer, which instructions will be binding on the assessing officer. Therefore, who is this JCIT and how does it gel well with 144 capital B provision? One. Two, and in the course of assessment, we also find the assessing officer saying that there is an arrangement, there is some transaction, I think something is not proper, something is amiss there, I need to make or call this as an impermissible avoidance arrangement. I have to invoke GAR. GAR has its own process concern, because they have to go to the commissioner, take his approval, then go to an approving panel. So let us therefore understand these two provisions vis-a-vis 144 capital B, the provisions of JCIT coming in and the provisions of GAR being invoked. How will they pan out tomorrow when these assessments are going to happen?
First question is really a tough question, where you have under 144A, in the normal physical mode, an assessment is going on by going on before the regular assessing officer, who could be DC. You would consider as an assessee, there is something is wrong with this DC, not, he is quite likely that he may make some sort of an atrocious addition, not based on law, which according to is completely impermissible. But then if you would allow him to pass an order, then you get into an appeal mode, you'll have to pay 20% for stay of balance 80% and, suffer the whole lot of litigation. So 144 capital A would permit you to go and approach the joint commissioner, the additional commissioner, and he could call for a record and give a direction to the assessing officer, which direction would bind the assessing officer. Now, this ability of the joint commissioner, the additional commissioner to give a direction could be either at the behest of the assessee when he makes a specific application, or suo motu by the JC. Sometimes, you would go and be interacting with the assessing officer. There is the adjacent cabin of the additional commissioner who would see him not visiting you at all. Okay. He would also want you to visit him for whatever reasons, in which case it could be a suo motu invocation of pass under 144A, and wherever he gives any direction which are prejudicial to you, you will have to be heard. And you know the meaning of principle of natural justice of having to be heard. Heard means what? You will have to go and meet him, right? Now, in the faceless scheme, if his assessment is being done by Hasan unit, in the course of correspondence, you will find that Hasan unit is going to make some damn bad addition, which is completely unsustainable and unthinkable by any man of reason. So he would want to approach the JC. Which JC should he approach? Should he approach the JC of Hasan unit? Should he approach the JC of Chamrajpet unit? As I've said earlier, Chamrajpet unit also has physical jurisdiction on him. Hasan unit also has the jurisdiction. JC of Chamrajpet has supervisory jurisdiction on AO of Chamrajpet. Correct? JC of assessment unit will have supervisory jurisdiction on the lower official in the assessment unit, because you need to know subsection 4 of 144B. it says assessment unit, verification unit, technical unit, and the review unit shall have the following authorities, namely 1. Additional commissioner, additional director, joint commissioner. 2. Deputy commissioner, deputy director, assistant commissioner, ITO. 3. Such other income tax authority, ministerial staff, executive, consultant, etc. Right. Now, if he would go to the JCIT of Chamrajpet assessing officer and would give a, and if the JCIT is kind enough to give a direction, he can give a direction only to his inferior authority, that is Chamrajpet, who is not handling his assessment. So it becomes infructuous. So the JCIT of Chamrajpet AO cannot give it to the JCIT who is heading the assessment unit in Hassan unit. Therefore, in our opinion, it is only appropriate that he would make an application to whom? The JCIT of assessment unit in Hassan. Because that assessment unit in Hassan is also at the top of it, has the JCIT in the additional, then he has to give the direction, which direction obviously would bind his inferior authority, who could be DC, who may be passing his assessment order. And therefore, according to us, the appropriate place to make an application on 144A would be to the assessment unit itself, which will have the JCIT. See, with one caveat here, we are yet to see how version 2 of 144B is going to take shape. We don't have much of assistance except the past experience and the text of 144B as its version 2. So all this will have to be, like taken with this caveat that, anything could change. SOP could change. They could bring a new SOP and which could possibly like alter the situation which you are envisaging now in a different way altogether. Yes, sir. This is the question on
144A.
You had
144B.
You had
GAR,
another question.
GAR.
If you look at GAR, presently 144B, how it is tuned with the transfer pricing, it is not as much tuned with the approving panel for GAR. See, if you look at the applicable GAR rules and 144BA, which will deal with the approving panel, it will first start with the GAR rules. Under the rule, if the AO has an assessment, let's say there is some sort of a transaction that has taken place, which appears to Hassan unit as a completely engineered transaction. It's a fit case for GAR. And it will fit into the threshold of GAR, beyond 3 crores and all that. Then, before he would even send a recommendation to the commissioner, jurisdictional commissioner, Hassan unit will have to first seek information from him. Some sort of a show cause notice has to be given under the applicable rule. So he has to reply, upon which basis Hassan unit is satisfied. Yes, it has to then make a reference to the commissioner. Then it is not very clear as to who is the commissioner who would have jurisdiction over Hassan unit, because it says the assessment unit would consist of only these many people. But I'm sure the additional commissioner, DCIT and such other authority which are constituting this assessment unit in Hassan would have a supervisory commissioner, definitely. In all likelihood, on the basis of reply which the Hassan unit gets from Mr. Padam, it has to then refer it to the commissioner, who is supervisory commissioner. There is no room here. He cannot seek an assistance in this regard because it is his call which he has to take. And none of the provisions of 144B provide for seeking assistance, unlike in the case of transfer pricing or valuation, seeking assistance whether it's a fit case for GAR to be invoked or not. Unless you read technical unit very broadly. Then the commissioner then will have to decide. He has to hear Mr. Padam then as to whether it's a fit case. If he would reply, commissioner may be happy that it is not a fit case for GAR, he may drop the proceedings. If the commissioner is not happy in terms of 144BA, he has to refer it to approving panel. All that is not contemplated in 144B. So wherever there is a GAR proposal, maybe he would intimate the NFAC, it's my guess. NFAC would possibly refer to some technical unit. Then technical unit considers a fit case. Then in terms of 144B, subsection 8, which says, notwithstanding anything contained in 1 and 2, the principal chief commissioner, the principal director, as the case may be in charge of NFAC, may at any stage of assessment, if considered necessary, transfer the case to the assessing officer having jurisdiction over such case with the prior approval of the board. So what they may do is, they may get the prior approval of board and then send it. One more option, they have an easier option, because every case of GAR to go to the board could be difficult. Another easier option is, wherever the GAR is found to be invoked midway, then they may say that under 144B2, it is a fit case for withdrawal. Or they may have to bring an amendment like a special audit. As I said earlier, clause 31 will talk about the special audit. Subsection 7 says if the special audit is going to go on, then the matter would be withdrawn from the assessment unit and would go to the local jurisdiction officer. They'll have to possibly bring in some sort of such measure so that there is complete clarity here. Now, there is absolutely no clarity. 144B is not designed to handle GAR at this stage, in our opinion.
We have seen the movements now between so many units concerned, so many provisions coming into picture. Who has the final say on all these matters concerned? From the assessment unit goes to the technical unit, goes to the review unit, goes to the verification unit. Are the reports given by these units binding on the assessment unit, or they're only of a recommendatory nature, meaning thereby that the assessment unit has the final say? That I shall, if I find it appropriate, accept it. If not, I will not accept it. Save the provision of transfer pricing where the TPO says I'm going to pass the order that's binding on the assessment unit. That we have considered. But leave out these specific provisions concerned, we have to therefore ask this question, that these units that are going to facilitate the conduct of assessment, they're going to render assistance to the assessment unit. Now, when you make a statement that they shall render assistance to the assessment unit, are they only therefore people who are helping you and their recommendations or their reports are not binding on the assessment unit? Specifically, when we make a reference to the review unit, there is a specific provision which says that the review unit, when it goes into the income and loss determination proposal, may make certain recommendations about what are the points that needs to be further improved upon. Now, when it goes from the review unit to the assessment unit, the law provides for 144B categorically provides that the assessment unit may reject and may accept. It may partially reject, may partially accept, it may wholly reject, it may wholly accept. Only condition therefore is that when it rejects, the assessment unit rejects the review proposal, it has to give reasons for it. Okay, you have to give reasons. So therefore, taking hint or taking cue from this provision, which says that the review unit report is not binding on the assessment unit, can we extend the same inference vis-a-vis the reports of the technical unit, vis-a-vis the report of the verification unit?
See, insofar as the suggestion by review unit is concerned, it's clear that it does not bind the assessment unit. It may accept, it may reject. If it were to reject, give reason. That's it. So review unit is clear. There are now a few more units: verification unit and technical unit. If you look at verification unit, what verification unit does, it conducts inquiry. It conducts cross verification. It will examine book, it will examine witness, it will record the statements, and it carries such other functions as may be required for the purpose of verification. So at the most, it would only give you certain findings. In a very, very few remote case, it may have to give an opinion. A cross-examination will have to be done. A statement has to be taken. What view a verification unit will take? For example, a statement has to be taken. It will go to the verification unit in Bangalore. Bangalore verification unit will meet Mr. Padam and take a statement. That's it. It doesn't give any view. Similarly, he says, no, that the witness will have to be cross-examined. Okay, that cross-examination will be conducted. It will be recorded in terms of Indian Evidence Act, and then it will move to the NFAC to be passed on to assessment unit in Hassan. So insofar as verification unit is concerned, whatever material that will come through the verification unit, the question of it being binding the assessment unit does not arise. It is more that the assessment unit would take aid of it. Now, When it comes to technical unit, one point is already dealt with, transfer pricing. When the technical unit also is an assessing officer, makes a reference to TPO, what TPO does binds, because the determination of total income will have to be in conformity with the arm's length price determined by the transfer pricing officer. So it binds, no doubt over there and no questions over there. There is no dispute on that. Now, what else could be done by the technical unit? Valuation. As I've said earlier, valuation of immovable property. It could be under 55A, it could be under 50C, it could be under 43CA, it could be something else under 142 capital A. As I've said earlier, wherever it's a case covered by 55A, valuation binds the assessing unit, in which case they're bound to do it. They're bound to follow it. Assessment unit is bound to follow the valuation. If it is a valuation not under 55A but under 142 capital A, in terms of subsection 7 to 142 capital A, it does not bind the assessment unit. They may only consider. So it doesn't bind. Now, when it comes to valuation of shares, could be for the purpose of 56.210, could be for the purpose of, as I've said, 56.27B, that tax on unjustified premium, 56.210. These are the situations, or 50C capital A. In all these cases, valuation would be done. And for the purpose of valuation, sometimes a merchant banker may be appointed, an accountant may be appointed. He may follow DCF method. He may follow the net asset method, NAV method. Can the AO question it? There are already decisions which have said that assessing officer cannot tinker with the choice of methodology. And if DCF method is used by an expert, assessing officer cannot get into that and modify it. So the general understanding of law on expert's opinion, for example, Bharti's case, the Supreme Court said the assess department is not having technical expertise. So it has to necessarily go and fall back upon the advice of the technical experts. There are plenty of decisions, like Bangalore bench in Innovate, in the case of 56.27B, has said that if DCF method is adopted, it is impermissible for the AO to tinker with the valuation procedure. Those aspects would continue to apply.
We'll wind up this by some small technical questions. I think we have come to the end of it. There are important questions. Now, we have gone through the exercise of finding out, ascertaining the movement of all these files, where, how it moves, when it moves, within what authorities it move, who are the persons who will be involved in the entire process of assessment. We have seen all of this now. Now, once the assessment is done under 144 capital B, assessment is completed. Assess what is the department having right about? It can say, hey, I'll have a 263 power. It can say have a rectification power. It can say have a reassessment power. Reassessment we'll deal with after the tea break. But it's important for us, therefore, that if I have to prevent the department from invoking 263, can I make a statement? Look here, the file has gone in through the review process, the technical process, the transfer pricing process. Multiple people have joined together. Review process which says everything that is important for assessment is concerned, all decisions taken into account, all points of facts considered, all discussion is appropriate. All those are recommendations concerned. That means if I were to use that, if I have access to that, I'll be able to resist the action under 263. Because I can say, look at the people who are involved in this. The file has moved between so many authorities concerned. So many people have applied their mind to the process concerned. What else do you think is there which makes the order erroneous? Can I therefore have a right to ask for the journey that my file has undertaken over the process of assessment? I need to ask, because ultimately after the assessment is over, it goes back to the assessing officer. But can I ask him now? I would like to examine my file. I would examine my records concerned and find out the journey that the file is undertaken solely with a view to understand where all my file have moved, who are the people who have applied their minds to it, such that I will have better rights of protection against a further action that the department may take against me.
This is a very important question. He mentioned the case of 263. There could be so many other cases of limitation under 153, whether it is done within time. How would you know as to whether an order is made within the time under 153? Is it that when it hits your mailbox, the assessment is made? Your portal is open, it has not come in there as it. 31st March, it has not come. Suddenly on 1st of April, when you open it, you would have the order coming over there. So we've been telling all our clients to keep screenshots. where you expected an order to come, but it didn't get uploaded. Keep taking screenshots of it from every day, morning and evening, keep taking screenshots. Okay. Now, insofar as 263 is concerned, just before I would even answer, if you would look at the process of 144B, see, assessment unit, first of all, your case would have been picked on CASS for scrutiny. So that means through their algorithm, machine learning, artificial intelligence, you may say whatever, nothing of that I understood so far. They would pick a case for scrutiny, means they have eliminated various other aspects, means there is some damn application of machine in it. Artificial intelligence has gone in to see as to why certain cases should not be picked. And even if it is picked, it would be picked for a few items like limited scrutiny for ABCD, meaning the rest of the things that there is an artificial intelligence that has gone into it to say that it's all done perfectly. So where is the question of it being erroneous in law is one aspect. Then it gets picked. The assessment unit would prepare an ILDP, right? Would send it to the NFSC. And what NFSC does, that under clause 16, it says, the NFSC may, on the basis of guidelines issued by the board, it may either accept or send it to review unit. That means even the reference to the review unit by NFSC is on the basis of what? Guidelines issued by the board. That means there is another application of mind by the board itself, who is at the helm of affairs under 116 at the top of department is board. The board has said these are the guidelines, which will have to be seen. After all this, it would have gone to technical unit, it would have gone to the verification unit, it would have also gone to the review unit, and all this process, several, brains have, got together here, eventually churning out your assessment order. Under what basis could it be called as erroneous and prejudicial? You will have an amendment made to section 263 or other cases where, your order could be considered to be erroneous and prejudicial, where the board directions not followed or whatever. Leave out those. We are rather on the more generic case of lack of inquiry. So could there be a case of lack of inquiry here? So that, how would you get to know all this? According to me, whenever you are prejudiced by the action of the department in terms of a show cause notice under section 263, where it is alleged that there is a non-application of mind or there is no verification of a particular thing, no inquiry that has taken place, you should have a right to ask for the information of the movement of documents from and interest a movement of your files. When, to whom, what question, on what guideline was it referred to? Was it referred to review unit? If one of the guidelines upon which basis it was referred to review unit is the area where the commissioner is having trouble in terms of 263, he cannot substitute his opinion on that because this has been already considered by the review unit on the basis of guidelines issued by none other than the board. I'll give you one more extremely important situation why you would require this. Of course, the answer is very simple. According to us, you will have to make an RT application and get this information. They have to give you this. Why do you need this information? More so, unlike in the case of version 1 of 144B, where NFAC itself is the assessing officer. So once the assessment is made, if NFAC were the assessing officer, it would simply dispatch the same to you. So it's just a straight, like posting your order by NFAC into a portal and with a real-time alert. So assessment order is not only made, but also dispatched and received by you. All would happen concurrently. But now it is not so. NFAC is no more your assessing officer, just a post box. Who is the assessing officer? Has an assessment unit. What it does? It passes an order. In his case, it will, under clause 22 of 144B1, it will pass an order. It will transmit it to the NFAC. And look at clause 22. It says NFAC NFAC thereafter pass the final assessment order and initiate penalty proceedings, if any, and send it to NFAC. Assessment unit will have to pass the order and send it to NFAC. Now, next clause says, 23 says, upon receiving the final assessment order, as per clause 22, NFAC shall serve a copy on the assessee. I have to serve a copy. I am NFAC in the example. Serve a copy on to him. Now, under 153, subsection 1, 2, all these subsections, the time limit is with reference to when the order is made. Now give me your answer here. When could you say the order is made? When assessment unit, which is the assessing officer, when it sends it to NFAC, is the order made? Or when NFAC would serve it on Mr. Padam, the final assessment order, is that when the order is made? The order, the language used is order is made, not served. Made means what? Made will have to be understood as issued, dispatched, meaning the assessment, see, NFAC is not the assessing officer. It cannot make the assessment order. It can only at the most serve the assessment order. Now, it is assessment unit in Hassan that can make assessment order. When it could be said that assessment unit in Hassan has made the assessment order? When it goes out of its control, correct? If it still holds on to it and not yet made the final assessment order and given to me, that means NFAC, it is to be considered as not made by it. But as an assessee, he would not know when did Hassan unit send it to NFAC. If he had sent it to NFAC on 1st of April, where the time limit was 31st of March, then order is time barred in terms of 153(1), correct? But how does he know? Now, as I would answer this question, you would also have to keep in mind subsection 6 of 144B. Clause 5, extremely important for you to know this. Time and place of dispatch. Look at this. Time and place of dispatch and receipt of electronic record shall be determined in accordance with the provisions of section 13 of the Information Technology Act of 2000. There's a time and place of dispatch and receipt. They've used the words dispatch and receipt separately, meaning they have different and distinct meanings. They cannot have the same meaning. So dispatch will have to be understood as made for the purpose of 153 and will have to be read in the context of clause 22, which the assessment unit is expected to make and send it to NFAC. Now, when they have made it, when has Hassan unit made the final assessment order? That time is critical for you. The time is critical. How is it to be determined? Subsection 6, clause 5 says it has to be determined in terms of section 13 of the Information Technology Act of 2000. And if you go to section 13, Information Technology Act of 2000, 13(1) says the time from issuer's perspective. 13(2) says the time from receiver's perspective. That is, when is he said to have received? 13(1) says, when is he said to have issued? You know what that says? He is said to have issued an electronic record to NFAC when that assessment order, which is the document in question now, enters the computer resource, not in his control. Look at this. The assessment order issued by Hassan Assessment Unit is considered as dispatch when that assessment order enter the computer resource not in the control of assessment order. What do you mean by it? When it enters the computer resource of NFAC, not when he sends. For some reason, it doesn't travel out of his box. His mailbox is full, some damn technical problem, it doesn't go out of his thing. That is not the time when it is made. At the time when it when it is sent, at the time when it enters into computer resource which is not in his control, that means NFAC. How would he know? Obviously, he has to seek it from RTI, or he can even write to NFAC, give me the screenshot or whatever, give me evidence as to when this damn thing has entered into your computer system. So that is where the seeking of information of interstate movement becomes extremely critical.
We'll end this session.
So one more point. Which,
last question.
Yeah, one last point.
Last question.
144B9, Mahad.
That's right.
Yeah.
That's the last question I wanted. That's the last
Yeah.
question.
Yes.
We've gone through all of this. Under version 1 of 144B, subsection 9 was there, which makes a statement that if the assessment order is passed not in accordance with the provisions laid out in 144B, the assessment order is void, non-est. That means there was a specific mandate that you have to scrupulously follow the procedure laid down under 144B. Otherwise, the order should be regarded as non-est. Subsection 9 has been deleted in version 2. It's not there now. Meaning what? Can there be a situation still now for us to challenge that an assessment order, despite the absence of subsection 9, will still be branded as non-est if it does not follow the procedure laid down under 144B? What should be the supporting material for this type of a conclusion?
144B9 was first enacted by Finance Act of 2021 alongside 144B. When 144B came in by Finance Act of 2021, with effect from 1/4/2021, it came with this subsection 144B9, which said that the order is non-est if it is not done in accordance with the provisions of subsection 1. On which basis, most of the lawyers like us have filed writ petitions. First thing, whenever we would get the faceless assessment order, we will see whether this is scrupulously followed. No intimation sent, not followed. Draft order not sent, not followed under the version 1. Show cause notice sent without the draft order, procedure not followed. Show cause notice with the draft order printed inside, no, not enough. As per the SOP, it has to be separately given. I'm telling you, these are the grounds on which we challenged. Writ petitions are pending because we didn't have better case or, better ground to challenge. What else to do? So somehow, have it quashed, let the damn thing go back or whatever. Most high courts, unfortunately, during the time when 144B9 existed, most high courts, instead of simply quashing, they remanded it. That was not called for. What section 144B said is, 9 said is, it is non-est. The court has to just say, declare law, non-est, matter ends. Court doesn't have to remand it, except some decisions. A couple of decisions of Gujarat High Court, a couple of decisions of Bombay High Court. The two not voluntarily, because they are so irked and irritated by the kind of hopeless orders passed, and they kept on remanding one after the other, and finally they got so tired and said, okay, next time if you pass a similar order, I'm going to impose cost on you. And in one case, Bombay High Court imposed the cost of 10,000 rupees to be recovered from the pocket of the assessing officer, to be given to PM Cares Fund, and copy thereof will have to be given to the petitioner. Look at, like salt on the wound for the assessing officer. Not only that he would pay, he would not only pay and come and tell the assessee, look, I have paid, and the assessee then will have to come to the High Court and confirm that yes, he has paid it. This is the kind of order passed by Bombay High Court. And of late, barring a few cases, rest of the cases were simply remanded. Bombay High Court and Gujarat High Court have said in some cases that no remand, we will leave it to you to do what is allowable in accordance with law. We will only quash it. So according to me, that is the right procedure, because section 144B9 said it is non-est. That's all the court has to do. It has to just declare the law as it does. Now, 144B9 by Finance Act of 2022 is omitted from the day of its birth. It is not omitted from now. It is omitted with effect from 1/4/2021. That means if you look at now the law, it has to be read as if subsection 9 never existed in the statute book. It's an omission without a saving. Royal Corporation case, Kolhapur Cane Sugars case, Constitution Bench of Supreme Court has held that if a provision is omitted without the saving clause, one has to read the law as if it never existed in the statute book. Now, all our writ petitions which are pending in the High Court will have to see 144B without the aid of 144B9, because High Court has to understand that subsection 9 never existed. So our grounds have fallen flat. Now, does that mean that without 144B9, you cannot pray for having the order quashed? You can. See, 144B9 just went one step extra to call it as non-est by legal fiction. An action need not be non-est merely because law declares it to be so. An action could be non-est if the court considers that the provisions of law are not followed, there's a breach of principle of natural justice. In all these cases, court can still quash. So therefore, if you would find even now that the procedures of 144B1 are not scrupulously followed, as a result whereof you are aggrieved, you are prejudiced because you are not been heard, you are not been given the notice of minimum number of days as the SOP says. In all these cases, you could still go to court and challenge, and the court, in exercise of its plenary power, can quash this order, but then they would only remand it back to the department. Except that it may go to a different assessment unit, though there may not be any sense of vengeance in them. They should not come back with vengeance, and for 10 crore addition, they should not come back and do a remand order for 20 crores.
He has one question. We'll take one question only and then we'll break for tea. Yes, sir.
All the cases will be reviewed?
No.
That,
All the cases would not be reviewed.
only few cases will be sent to there.
In
What
accordance
is
with what is the board?
under what circumstances it will go to the review?
No.
Two things. Clause 16 you have to see. I'll read this for you. Upon receipt of ILDP, the NFAC, on the basis of guidelines issued by the board, assign the ILDP to a review unit through an automated allocation system for conducting review of such proposal. So we do not have the benefit of what the guidelines of the board are now. And you, according to us, like continuing with my answer to the question as to, can you ask for inter-se movement? Can you also ask for what guidelines do you have? According to us, there is nothing wrong, nothing will preclude our right to ask for the guidelines, which from time to time the board would issue. No, it's just, the
new section.
It's just a new section. Whatever we are discussing, please don't, apply it for version 1 of 144B. Whatever we are discussing is only for version 2 of 144B.
We now break for tea and come back in 15 minutes. The second leg of the discussion goes on reassessment. 1987 Finance Act, they tried to change reassessment. if the assessing officer is of the opinion, that was the proposal made at that point of time, is of the opinion that income chargeable to tax has escaped assessment. Earlier to that was, if he has reasons to believe. For the first time, they proposed an amendment to say, if the assessing officer is of the opinion. From the bill to the act, there was a lot of hue and cry. As a result of that public pressure, they restored back in the act reasons to believe. So the attempt by the government to say if the assessing officer is of the opinion, that never saw the light of the day. So 89 onwards, till 2022, we have had the law continuing largely. Amendments are here and there. But then, over a period of time, this reason to believe became the cornerstone of a lot of decisions of the courts concerned. Reasons to believe and the change of opinion, they become the biggest factor in favor of the SSC concern. Department did lose many a battle. They are now trying to therefore overturn their position of strength by introducing certain changes, and therefore they have substituted 147, brought in a new procedure laid down. During the course of this litigation, we also had a number of Supreme Court decisions. We normally refer to the frequently quoted decisions of Kelvinator's case, Rajesh Javari's case, GK and Drive Shaft case, and lot of decisions. Highest number of decisions, if you look into ITRs in recent times, have been on 147 and the rights of an assessee available. GK and Drive Shaft did bring in a procedure which was not there in the statute, but therefore it became some sort of a court-made procedure that at what point of time could you challenge an action proposed under 147. You can't rush to the High Court immediately when a 148 notice is issued, is what Supreme Court said. They said, file a return in response to the notice, ask for the reasons, obtain a copy of the reasons, file your objections to those reasons, have the disposal of those objections, and at that stage, if you're not still happy with the way in which ITOs dealt with your objection, at that point of time, you could approach the High Court. Some sort of this procedure has now been incorporated into the statute itself. 148 capital A provides for that procedure which the Supreme Court had prescribed originally. It was a judge-made law then. Some shades of that is now available to us in the statute itself. Therefore, our process of challenge to a 148 notice will have to be seen in the light of the new procedure under the law. Those principles of Supreme Court may not necessarily hold true today. We have to be mindful, therefore, of the changes concerned. We also have to be mindful of the fact that today, the reasons to believe, those words are not there in the statute. The phrase is not there in the statute. Does it give rise to a difficult area for the department, or does it give rise to an easy area for the department? So, our principle that we have associated with 147, the reasons to believe, the change of opinion, full and true disclosure, there have been significant changes to these concepts concerned. So our discussion will corner around the substance of 147. What does 147 tell us? In what manner there has been a change today? And therefore, we will have to go into the fact whether 147 today has something of a more rigorous procedure, or does it dilute from a department's point of view the standard of test that the department should have in its favor for the purpose of reopening an assessment concern. 1. 2. We've also seen this transition happening between the old law and to the new law. We all believe that this is a part of the procedural law. Chapter 14 deals with procedure for assessment. 147, 148 are a part of this chapter which deals with procedure for assessment. And the general belief is that anything that is procedural in nature should be applicable to all ongoing proceedings. Therefore, to that extent, it is retroactive in effect. It takes into account, if you're trying to initiate a 148 today, on 16th of April, for an assessment year 1920, are you going to apply the law or 148 as was there in force in 1920 assessment year, or are you going to apply the law today? If it is a procedural law, that means all actions today will have to be in compliance with the law as in force today. If that were to happen, therefore, then the question is that this is also relevant for 144B, but because of positive time, we did not deal with. What happens when a procedure is initiated under 144B under the erstwhile law? Can you continue that procedure under the new law? And it's more important in the context of reassessment. If a notice has been issued prior to 1/4/2021, would you be able to continue those proceedings concerned, or would you now have to go over all over again to the new procedure, new law, and comply with those procedures? If there is therefore a non-compliance with the new procedure now, can you now challenge the action as not being in accordance with law? Although at the time of initiation of the action concerned, it was in accordance with the law at that point of time prevailing. So this provision, this type of provisions concerned become therefore important. The transitory provisions become extremely important. Do they therefore afford a ground for you to challenge to say that a new law ought to have been followed, although the action was initiated appropriately, since you're not complying with the new law, there is a fault committed by the AO leading to the entire process of reassessment going waste as far as the department is concerned. This becomes very important for us, one. Two is also important for us, therefore we'll have some initial comments by Chythanya on this matter concerned, that these transitory provisions and the substance, the nub of the whole issue. What did the law originally say? If the assessing officer has reasons to believe that income chargeable to tax has escaped assessment, he may, subject to the provisions of 140 to 153, assess, reassess or recompute, so and so provision. What does the law today say? The word reasons to believe are not there. It says that income has escaped assessment. If the assessing officer, no restriction of reasons to believe. If income has escaped assessment, then you can reassess the assessing concern. So question therefore is, the earlier words were, has reason to believe that income has escaped assessment. Current wordings are, income has escaped assessment. Is there a distinction from the old word? The obvious answer is yes. Now, has it made the standard tougher or has it made the standard easier? I'll therefore ask Chythanya to combine all of this to give the answer concerned. We had broken this into subsegments concerned, but it's important for us because of we may not be able to complete the entire discussion by 8:15. I will therefore ask Chythanya to combine a couple of these very substantive provisions concerned and the import of these provisions in the current situation. So be mindful of the fact that the word reason to believe are not there. If income has escaped assessment. Now, income has escaped assessment. Is this a reality? It should come to a conviction that income has escaped assessment for you to begin the process of reassessment. The feeling initially was, earlier was income, reasons to believe. Are you now saying if the AO has reason to suspect he can have 148 now? Has it dilated him? Or the wordings are giving him a tougher test to say, no, it has to be a conviction that income has escaped assessment because of the mandate of 148, 147. Now, this has to be read with the procedure laid down under 148 and 148 capital A. It's important for us to know when can a notice under 148 be issued. You have to have this belief to say income has escaped assessment. There is a proviso to 148 to say that what shall be the circumstances under which you will have the 148 can be issued only when there is information with the assessing officer suggesting income has escaped assessment. At that point of time, he possibly gets a jurisdiction. He has to comply with the procedure laid down under 148 capital A. So 148 and 148 capital A work in tandem in some way or the other. He has to therefore have information with him. There could be information that is there by statute, or there could be deemed information suggesting escape out of income. So explanation 1 and explanation 2 to 148 will deal with these circumstances. We'll come to those circumstances a little more in detail during the course of our discussion. But broadly, what will be the scheme under which today 148 operates? And what will be the scheme, the conditions, preconditions of 147, the transitory provision. This becomes an extremely important issue for us to understand. Therefore, some comments on the substantive portions of the law and the changes, material changes brought about by this process concerned.
See, the edifice of 147 has undergone a change, a paradigm shift. As Mr. Padam rightly said, earlier, the jurisdiction to assess or reassess would have come to the assessing officer in terms of 147, if he has a reason to believe. if you have a reason to believe, you would have had the jurisdiction. You have decision of Supreme Court in Parshuram Pottery case 106 ITR 1 that the tax proceeding, like any other civil proceeding in the life of a man, will have to have finality. So there has to be an end to all these. So reassessment cannot be done at the drop of a hat. So it has to follow the rigorous test of law. You have Shivnath Singh, 82 ITR 147, Supreme Court said reason to believe. Calcutta discount, 41 ITR 191. Shivnath Singh, 82 ITR 147. Reason to believe is not reason to suspect. So that means the earlier law said that you would have a jurisdiction to reassess my income if you have a reason to believe. Then Supreme Court in Rajesh Javeri said in 291 ITR 500, well, reason to believe is not as bad as reason to suspect. But at the same time, reason to believe is not as good as actually coming to conclusion that income has escaped assessment. See, there is reason to suspect that the income has escaped assessment at one extreme. At another extreme, you have income that has escaped assessment. The reason to believe that income has escaped assessment falls somewhere in the middle of it, is what the Supreme Court said. Now, if you look at 147 now, they have said where the income has escaped assessment, that means it has reached the other extreme. Is unless and until the income has escaped assessment, the AO does not have jurisdiction to assess or reassess. 147 per se is inapplicable if the income as such has not escaped assessment. Understood thus, it looks as though 147 now will have to pass a much stronger test. But then, of course, as you would see the procedure laid down a little later, it is not as in this extreme position as I am trying to project now. There is a midway path which will come to a little later. But with all this, see, my extreme position is what? First to establish that income in fact has escaped assessment, then you invoke the powers. See, the one extreme is that unless and until the assessing officer has come to the final conclusion the income escaped assessment, which process he has to do before even he would issue notice under 148, because the jurisdiction to assess is assumed through issue of notice. He cannot do anything is one extreme, which the court may not agree. Then somewhere, like just to still make it stricter, but not as much as the extreme position. One another point which may have to be understood here is, like when the income which is chargeable to tax escaped assessment, what the AO can do, he can assess or reassess or recompute. So there could be assessment for the first time under 147 if it is not preceded by a scrutiny in the past, which you are aware. Rajesh Javeri has made it very clear. Now we look at the case of reassessment where you were already previously assessed. Then what is he trying to do? He is trying to reassess. So power to him is to reassess. This power does not extend to review. This is where the Supreme Court in Kelvinator 328 ER 561 said, the power under 147 is not a power to review. It is a power to reassess. Meaning, in respect of your action on a given set of material, you cannot be allowed to review the same position which you have taken on the very same material which were before you. So the section asset does not permit you to do the review. And then Supreme Court went on to add a word of caution saying that because the power is not power to review and the power to reassess, we have to read change of opinion into the section. This phrase change of opinion is never found neither in the past nor now. The Supreme Court in Kelvinator said change of opinion is a phrase that has to be read into this to avoid the abuse of this power and to avoid the upgradation of this power from power to reassess to power to review. So if you're allowed to change the opinion on the same set of factual matrix, that means you're not reassessing. What are you doing? You are reviewing. So therefore, although the words change of opinion did not exist in the erstwhile 147, Supreme Court read that phrase into it, and for no reason why that should not be read into present 147 also, because the very same power is available under 147. Are you able to understand what I'm trying to convey? So you have to project a situation that if the action of the AO in terms of 147 read with 148, he may satisfy all the conditions of 148 and 148A. There may be information suggesting that income has escaped assessment. There may be a process which is followed in terms of 148A. There may be a speaking order. With all that, if you are able to project that it is not a case of reassessment, it's a case of review, even then the reassessment under 147 is impermissible. So this part has to be very, very carefully held to your chest and be applied in all given situations. Now the words reason to believe are missing. The words reason to believe are missing here. What is this reason to believe? And what are you now required to have? So as you would see little later, section 148 says, so 147 is a power to assess, reassess, or recompute, which power is subject to provisions of 148 to 153. So whatever you do would be subject to 148 to 153, meaning you can't assess or reassess or recompute under 147 unless you would issue a notice under 148. And for you to issue notice under 148, subject to exception, which we'll deal with later on, assessing officer has to have information in his possession suggesting the escapement of income. Information suggesting escapement. What is it? Information suggesting escapement. In short, we'll call it as ISE. So assessing officer has to have information in his possession which suggests that income chargeable to tax has escaped assessment. What is this information which is suggesting escapement of assessment? You have an exhaustive list of cases that only under these cases it could be said that you have information suggesting escapement of income, not in any other case. Meaning there is an exhaustive meaning to this phrase, information suggesting escapement of income. Now that is the edifice precondition for proceeding for reassessment, subject to other procedural requirements. Now you have to juxtapose reason to believe as it then existed versus information suggesting escapement. Look at this. Reason to believe is that you had umpteen scope as an assessing officer to believe that income has escaped assessment. It is not in any manner circumscribed by situations. It is something which couldn't have been defined in exact proposition as to when you have a reason to believe. I could have a reason to believe that any income in any whatever circumstance would have escaped assessment. It is so broad and wide, and it was circumscribed only by the judge-made inbuilt propositions. That is, reason to believe will have to be a subjective belief, but based on objective criteria. Otherwise, it will result in some sort of an arbitrary action and discriminatory action. I like assessee A, I don't bother in respect of same issue. I do not like assessee B, I will trouble him because I will have a reason to believe and I don't have a reason to believe. How is it possible? Though the belief as such is subjective, your belief is not my belief. So belief is completely subjective, but it is not just the case of assessing officer believing that income has escaped assessment. Assessing officer has to have reason to believe that income has escaped assessment. The word reason to which will add as a prefix to the belief will bring in an objective criteria on which basis I'll have to make a subjective opinion that the income has escaped assessment. What is this objective criteria? Then the Supreme Court in Kelvinator and earlier cases brought in that objective criteria is I have to have tangible evidence. This tangible evidence, of course, it's completely, what I would say is extremely controversial as to what is tangible evidence. Is it to be external? Could it be internal? Could it be new material? It has to be only the existing material. Let's not get into this controversy now. What I'm only trying to say is, under earlier law, reason to believe was broad enough, but circumscribed by objective parameters, because the court insisted that you have to have a tangible evidence and a live connection with the tangible evidence and your forming belief. Then it will fructify into a proper reason to believe. I can't have some extraneous evidence and will have a belief that the income has escaped assessment. There has to be a complete nexus, a discernible nexus between the material which I'm in possession of, which material as a man of ordinary reason, when properly instructed, I would say on the basis of these reasons, I have formed a belief that the income has escaped assessment. What in gist I'm trying to say is, under erstwhile law, reason to believe was very, very widely, constructed, but with objective parameters introduced into it by the judges of the court. One part. Now come to information suggesting escapement, which is the basis upon which you can proceed with the reassessment. Here, they have outlined an exhaustive set of circumstances. Only in this set of circumstances, you can have information suggesting escapement of income, meaning your wide, scope of forming a reason to believe is no more there. It has to fit into this set of box. This set of 4 or 5 items, which we'll go through later on in terms of explanation 1 to Section 148, which will enlist as to what are the cases where the information could be said to exist with assessing officer suggesting escapement. Only in those cases, you would have jurisdiction, subject to exception, of course. We'll come to later on. So this is where you could see the change in the scope. Now, transition, do I deal with now? Yeah. Now, there are some transitional issues which we'll have to see. See, we have seen the law of reassessment underwent the change by Finance Act of 2021 with effect from 1/4/2021. The memorandum explaining the clauses, the notes on clauses, and the finance minister's speech as she presented the bill all suggest that the existing reassessment law is complex, giving lot of discretion, would not have made the doing business easy, and therefore, keeping in mind the ease of doing business, keeping in mind bringing finality to tax proceeding, keeping in mind the technological advancements like artificial intelligence and machine learning, etc., which would have been brought into the scheme of your faceless assessment, where the scope for escapement may be much less. Keeping in mind all this, the finance minister brought in amendment by completely recasting the reassessment provisions from 147 till 149, including section 151 and 151 capital A. Now, we have had different situations in our, dealing with the new provisions. Mr. Padam mentioned that the reassessment procedures are procedural in nature, not substantive, and therefore, no matter which assessment year you're dealing with, the new law would apply. Whenever you would look at it, be it relating to assessment year 1819, be it relating to assessment year 1920, but post 1/4/2021, which law you look at? The law that presently exists. It's not the substantive law. This is the procedural law. In fact, the Central Board of Direct Taxes in the Circular 549 itself has conceded that the reassessment procedures are procedural in nature. They're not substantive in nature. The law of the day would apply to it, not the law that was prevalent during the relevant assessment year. Is this clear? Now, so for the past years, like 1617, 1718, 1819, we have had two situations essentially. One is where the notices were issued under the old regime. That means the new law came in from 1st of April 2021. Notices would have been dated on 31st March of 2021, 30th March of 2021, 15th March of 2021. Is one set. Only notice is issued, nothing else has been done. Another set is for the past years, notices are issued on or after 1/4/2021. Are you able to understand this? Because they had the time limit. So up to 31st March 2021, erstwhile 149 provided for a time limit, as you would know, of 4 years, 6 years, 10 years, and 16 years, where you have income from an asset which is located outside India. So 4, 6, 10, and 16 years. 10 years you had in a situation where you are covered by 153A or 153C. You had 10 years, up to 10 years they could have gone back. Up to 31st March. Thereafter, the new section 149 will provide only two-way time limit. 3 years or 10 years, that's it. 3 years or 10 years. Mostly 3 years, in exceptional cases 10 years, which we'll see how and when later on. So now, for the past years, we have two situations. In one set, notices have come at the fag end of March 2021. Another set, notices have come after 1st of April of 2021. Are you clear? Now, what the revenue did is, they did the goof up of issuing notices after 1/4/2021 without following the new law. They rather followed old law of recording reason to believe under 148(2), then would issue notice to you, expect you to file the return and seek reasons. You are given reasons, you file objections, I'll overrule objection, I'll issue notice thereafter under 143(2) if you don't tap the door of the High Court on a writ petition. So this is what they were they were still in that, and they started issuing notices post 1/4/2021 without following new law. This became a point of litigation. So we had a series of decisions of High Court, except Chhattisgarh. What Mukeja? Palak Katuja, except Chhattisgarh. You have Ashok Kumar Agarwal in Allahabad High Court. You have Taneja in Rajasthan High Court. And you have the Madras High Court decision. You have had Delhi High Court in Manmohan Kohli's case. You have Calcutta High Court decision. And we have a batch of petitions being lined up to come on next Monday in Karnataka High Court and Tuesday in Hyderabad High Court. So except Chhattisgarh, all high courts held that reassessment procedures being procedural in nature, the notices issued, because they all dealt with the case of notices issued after 1/4. So notices issued after 1/4/2021 will have to follow the procedure of new law. And if not so followed, they have to be quashed, leaving the department the right to do what they want to do in accordance with the law, provided time permits. See, department wasted 1 good year fighting this. They should have rather withdrawn the notice and issued new notice immediately. That they could have done. They did not do it. They rather nonchalantly kept on fighting this case and wasted a year, and they lost still more time. Now the courts have said you have time to issue notice under new law and process. Because under new law, what is the time limit? Only 3 years. Under old law, you had 4 years, 6 years, 10 years, 16 years. So department lost valuable. And the matters are also lined up in the Supreme Court, and they're expected to come sometime in, maybe in May, just before the vacation. We will not know what the Supreme Court will have to say, but in all likelihood, considering that majority of the high courts in the country has held that this is a procedural law, and the procedure as stands today will have to be applied. So therefore, the law of the land is that the notices issued post 1/4/2021, no matter which past assessment it may relate to, will have to follow the law as of today. This is point number 1. Point number 2, notices were issued at the fag end of March. So notices were issued after recording reasons to believe. Notices were issued. Now comes new law. So he has to proceed with the assessment. Which law does he have to read? Just because he issued notice on 31st March, should he read the law then existing, or should he read the law that he reads now? He has to read the law that is available now. What is the law that says now? Does it use the word where he has a reason to believe? It does not. It says where the income chargeable to tax is escaped assessment and subject to 148 to 153, meaning even if the notice is issued in the past, such notice lapses because the basis of that notice was reason to believe, which basis no more exists in the law. No more exists in the law. The Supreme Court in GKN brought out a procedure that file return, seek reasons, file objection, get an order overruling objection, then come to court. All that is not necessary now for the reason that under the new law, the question of reason to believe does not arise. So where is the question of furnishing reasons? One more thing. When they substituted section 147 with the brand new set of sections, they have never taken care to have a saving clause. What is saving clause? You look at 142 subsection 4. It has a beautiful saving clause. It says up to the assessment year 21-22, which assuming the parliament wanted to take care of the past, up to the assessment year 21-22, for the purpose of assessment or reassessment, law as it then existed would apply, could have been the provision. That is the saving clause, and they are not brought in the saving clause. When a provision is substituted without the saving clause, it is like taking the act, look at the old words, then existed, erase them, write the new law, hold the book. This is not what I'm saying. G.P. Singh's interpretation on substitution, as analyzed by Supreme Court, says substitution means take the book, scratch the sections, write the new sections, and read it as it is, meaning what stood substituted is deemed never to have existed in the statute book, except when it is saved, which they are not taken care of saving it. Now, Section 6 of the General Clauses Act, which will save the repealed act. This is old act is repealed. And for Section 6 to come, the law has to be substantive, whereas here the law is admittedly procedural. So Section 6 would not apply. Secondly, for Section 6 to come, there is a caveat, unless a different intention exists. Now, where is the different intention? Different intention exists in the form of a memorandum, in the form of notes and clauses, in the form of the budget speech, where the FM says, I don't want old law has to be substituted, meaning there is a different intention, which means they never wanted to save it. That is the second defense for you to argue that Section 6 of the General Clauses Act, which will save your past conduct, does not come to the aid of the revenue. So on this basis also, there is a batch of writ petitions which are filed in Karnataka High Court. Tuesday in Karnataka High Court, we are dealing with a batch of writ petitions which will deal with the notices that have been issued in March, but assessment was continued under law that then prevailed, not the new law. So this is the position of law that then existed, law that's going to exist now.
The jurisdictional condition of escaping assessment, for the time being, we'll hold on. There are 2 or 3 other provisions also to be dealt with. We were discussing 144 capital B. We are looking at 144B applying to assessment under 143.3 or 144. Rightly or wrongly, we have a mention of 147 also under 144 capital B. If you look into the scheme which are there under 143.3A, it only referred to assessment under 143.3 or 144. There are no reference to 147 there. Although if you went down the scheme, the old scheme, they had a reference made to a notice being issued under 148, but there are no explicit mention in the erstwhile scheme about 147 being covered within the regime of 144 capital B. Current 144 capital B has a reference explicitly mentioned to an assessment under 143.3 or 144 or 147. Explicit mention is there. This has to be read with 151 capital A, which talks about the faceless reassessment scheme. That means a reassessment should happen in a faceless manner in accordance with 151 capital A, for which a separate procedure or a separate scheme has to be notified. Rightly or wrongly, 147 has now been mentioned in 144 capital B. Therefore, one more facet of this transitory provisions. Whether 144 capital B is strong enough, is wide enough to include 147, or could you challenge 144B as not taking into account 147 proceedings, because those have to be done in accordance with 151 capital A, becomes a point for discussion. Therefore, before we go into income escaping assessment, 2 or 3 jurisdiction conditions we'll deal with, then move into income escaping assessment. Therefore, this is the question for whether 144B today is strong enough to also rope in or incorporate a reassessment action.
Section 151A, which Mr. Padam mentioned, deals with faceless assessment of income escaping assessment. This is worded on identical terms as 143(3)A, which dealt with the faceless scheme. Before, by Finance Act of 2021, we had 144B coming into play. Interestingly, 151A doesn't have non-obstante clause. It doesn't say notwithstanding anything contained, doesn't have that. But 144B subsection 1 has non-obstante clause, and it also refers to 147. So now, by just looking at the text of these two sections, it appears that 151A should yield to 144B, because though 151A is a special provision which deals with reassessment, though it's a special provision and applying the principle of generalia specialibus non-derogant, that 151A would have prevailed, but because of use of non-obstante clause in 144B, subsection 1, which uses 147 as well, it has to be understood that 151A is overridden by 144B, point number 1. They have very smartly addressed this problem. In 151A, which provided for a scheme to be brought out by the central government for reassessment, they brought out a scheme and they notified a scheme. The scheme was notified, in notification 1466 dated 29/3/2022 for under 151A. You know what they've said? For the purpose of this scheme, under 151A, they've said assessment, reassessment, and recomputation under section 147 and issuance of notice under 148 shall be through automated allocation in accordance with RMS formulated by board as referred to in 148 for issuance of notice. Now hear me carefully, and in a faceless manner to the extent provided in section 144B with reference to making assessment or reassessment of total income or loss of the assessee. They have very smartly linked this scheme. This scheme is hardly half a page. And they've linked the reassessment under 147 to the extent provided by 144B. So therefore, there is no incompatibility, and therefore a reassessment or an assessment under 147 could now be comfortably done under 144B.
Under the erstwhile law, when I began the procedure for reassessment, I gave a notice on a particular ground. Let us say I gave a reassessment notice on ground A and ground B. During the course of reassessment, could have gone into ground C and D and add those to the final order of assessment. Controversies existed. Jet and Ranbaxy said a particular thing because the words used were and also assess any other income that may come to his notice. And also, in the opinion of these courts, presuppose that there was an addition on the ground for which you had initiated reassessment. Having done that, you could have added something more on ground C and ground D. Karnataka High Court went a little differently in Govind Raju's case to say, no, there need not have been an addition on ground A or B. I could have just gone to ground C and D. That controversy was existing. But then there were explicit words then used in 147 to say any other income that the AO may find during the course of reassessment. And we also had explanation 3 below 147 to say that you can make those additions, although the reasons originally mentioned were confined to ground A and B, did not have a reference to ground C and D. Therefore, the need for you to give a reassessment notice all over again under 148 was not required to be complied with. I could have gone ahead and made the additions concerned. Those wordings now are missing in the main body of 147. That means any other income that I could find or discover in the course of reassessment, I could add on. those wordings are explicitly missing in the main body of 147. You find only an oblique reference to this in the explanation below 147. In the explanation below 147, you find an oblique reference to this. Now, when you find an oblique reference to 147 in the explanation there under, and you go around and read the entire section of the explanation, it says, subject to the conditions of 148 capital A being full, 148A being fulfilled or not being fulfilled. There is no reference to 148 there. Meaning thereby, if I want to add in this current scenario now, I want to make additions on ground C and D, although my reassessment is on ground A and B. Can I come to the explanation very easily and make an addition on ground C and D? Or for this ground C and D, I will have to go back and comply with the procedure all over again under 148. Otherwise, I will not be permitted to make an additions on ground C and D. It's a matter for discussion.
This again will have to be, as he rightly put, understood under old regime and the new regime. Now, under the old regime, before 1/4/2021, let us say reasons are recorded that incomes A and B chargeable to tax have escaped assessment, right? Reasons are recorded. Then a notice is issued to you. You would file a return and ask for reasons, that is A and B. I will give you reasons. Then you file your objections. I overrule the objection. Then I proceed to issue 143 notice, 3-2 notice, and start assessing you in respect of A and B, correct? And as I would do it, I would ask for details in respect of A and B, and I bump into an additional info which will suggest that C and D also have escaped assessment. C and D also have escaped. In the course of examination of books of account, etc., I would find C and D. In the old law, there were two provisions. One was built into 147 itself, which permitted me to assess or reassess or recompute A and B. And in the course of such assessment, I can also assess and also C and D and also C and D, right? So main body of section itself permitted me in the course of assessing A and B, as I assess A and B and also C and D. And also was a point of litigation, controversy. For C and D, should A and B or either of them exist? See, it may so happen that I may assess you for A or B or A and B and also go for C and D, one situation. Another situation, I may drop A and B and go for C and D. Govindraju said you can't do that. Ran back C and Jet, Bombay High Court and Delhi High Court said you can't do it. For you to do C and D, there has to be either A or B or both. Are you able to understand? This was the controversy which was built into the main body of erstwhile 147. That apart, we had explanation 3, which said that I can proceed to assess or reassess C and D, although in the reasons recorded originally, I had not noted them. Are you able to get me? So two defenses were available to the assessing officer. One was built into the body of 147. The other was by way of explanation 3 to erstwhile 147, which stated that no matter I have recorded them in my reasons, I could have still gone ahead and assessed you. Clear? What does the present law say? Same situation, present law. I am going to have already, passed through the stage of 148. In respect of A and B, I have information suggesting that income has escaped assessment. Then I have given you a notice under 148A. You have replied. I have passed an order saying that's a fit case for reassessment according to new law. And I issued you a notice under 148 for A and B. You filed the return. Then I processed the assessment under 143. 3 read with 147 and then bump into C and D, correct? Now, the words which are built into the main body of 147 are conspicuously missing now. 147 body as such does not say I can also assess any other income that comes to my knowledge or notice in the course of reassessment. Those words are not there. So one defense is gone. Now, in place of explanation 3, which then existed, which stated that under old law, I could have assessed C and D without having to record reasons in respect thereof. They have brought in a new position here to say that I can do it, I can assess you C and D, even though I have not followed the procedure of 148A. So I don't have to follow the procedure of 148A. I'll repeat again what procedure normally I have to do. I would have to have information suggesting that income has escaped assessment in terms of 148. Then I'll have to give you a notice under 148A. Here you pass an order under 148A, then issue notice under 148. Okay, this is the present law. Now what they are dispensing with is only the procedure which I have to follow under 148A. They are not dispensing with the requirement of information suggesting escapement. That means if I have to assess you C and D now, unlike under old law where I don't have reason to believe, under new law, I have to have information suggesting escapement in its restricted sense of explanation 1 to 148 in respect of item C and D. It has to qualify to be information suggesting escapement of assessment, number one. Number two, I have to issue another notice under 148 for C and D because my ability to assess C and D, which was found in the main body of section 147 as it then existed, is no more available under new law. The defense which was available is not available now. Therefore, as an assessing officer for C and D, I have two-fold requirement. Requirement one, C and D will have to fit into information suggesting escapement of income. Requirement two, I will have to issue notice under 148. Of course, I don't have to follow 148A. Only what is dispensed with is the extra procedure of 148A. I have to issue notice under 148. You have to respond by filing a return of income, and I have to assess it separately in terms of C and D. So this is our understanding of the old law juxtaposed to new law in respect of additional items of income that will come to the notice of the AO in the course of reassessment.
Under the old law, we'll take the same example. Ground A and B, additions have been made. I have gone in appeal against these two grounds. Appeal order also is passed. In relation to ground C and D, now AO finds that I didn't make an addition originally. Ground C and D. What has gone in appeal is ground A and B. Question therefore before the courts was, when I had taken the matter in appeal, an appeal order has been passed, whether there's a merger, and what extent is the merger? To provide for the ability of the assessing officer to make additions on ground C and D, they brought in a proviso to 147 saying that only those matters that have been taken up in decided in appeal, there shall be a merger. In relation to all other matters, the assessment order shall be deemed to be existing valid. That means they brought in a concept of partial merger and merger to the extent of grounds A and B, which are taken in subject matter of appeal, and therefore those have merged with the appellate order. That means in relation to grounds A and B, you don't have the right to make a reassessment. But in relation to other grounds, C and D or E, whatever you want to find out, explanation, the proviso very clearly said that the AO will have a power of reassessing if you find that he has reasons to believe that income has escaped assessment in relation to ground C and D. In the new law, this proviso is not there. So, can we make a statement now that under the old law, there was an explicit saving or an explicit mention of a partial merger only. Explicit saving means saving in relation to those matters not considered and decided in appeal. AO has the explicit saving. He has the reserved power to say he can make a reassessment in relation to those. Therefore, to that extent, negatively put, there's only a partial merger. The assessment order continues to exist for other grounds. That type of provision is not there. So what will be the position under the new law? Can I make a statement now? Since there is an absence of such a merge provision now, can I make a statement that the order has fully merged? There's a complete merger. What survives, therefore, is the order of the appellate authority concerned. That means the assessing officer will have no power to assess ground C and D, although they were never a subject matter of additions made in the original assessment.
See, to get an answer to this question, you have to understand the concept of merger. What is merger? When an order of inferior authority is touched by the superior authority, is interfered by the superior authority. Not that it needs to be interfered 100%. The moment it is reaching him and he has dealt with it, there is a merger by default. There is a merger by default. For example, let us say an AO has made an addition in your case for 4 items, A, B, C, D. There are 10 items in your basket of incomes. 6 he is happy, AO is fine with you. He makes addition for 4 items. You take it to C8 appeal. You are okay for first 3 items because paltry additions were made. 4th item you are unhappy. You just take the 4th item to the C8 appeal. 10 items, 6 complete consensus between you and the AO. 4 items, no consensus, additions made. You are happy with 3. You go on 4th item to C8 appeals. Now the C8 appeal will partly allow, not allow, dismiss, do whatever. Ultimately, he passes an appellate order. By default, by rule, the order of AO merges with the order of C8 appeal. So we have the decision of various courts. Karnataka High Court in V.F. Arvind Brand's case in the context of sales tax. And you have Kerala High Court in Vaikundam rubber case. You have Supreme Court in SLP, dismissal in Radhaswamy Salt Works case. You know, these are the situations. Plenty you will get. By default, there's a merger. So what the parliament feared is, the moment there is a merger by default, assessment order does not exist anymore for anyone to reopen. So assessing officer would not have power to touch that order because it has already reached the hands of a superior authority. How as an inferior authority, I can consider the order which has been touched by the superior authority. Inferior authority's order is already merged with that and ceases to exist. So they made provisions in various places in Income Tax Act. One is they did it as third proviso to section 147 and the old law. If you go to 154, you have the concept of partial merger. You go to 263, you have the concept of partial merger. What is this partial merger? They have said that, look, if the matter is taken up in appeal or revision, it will merge with the superior authority only in respect of issues dealt with. Are you able to understand? Only in respect of, in our example, how many issues are dealt with? 10 issues, 6 no problem, 4 addition. You have gone to C8 appeal on 4th issue, only 1 issue. Under normal law, complete merger. But then Income Tax Act and other taxing statutes provided that no, there is no complete merger, because if I keep quiet, there's a complete merger and no rectification is possible, no revision is possible. The law provided an exception to complete merger by explicit law, stating that it is no complete merger, it will merge only in respect of 4th issue. That means other issues are open for reassessment, open for revision, open for rectification. Have you understood me? Now, for some reason or for no reason, this concept of partial merger is not brought into chained 147 proceedings. Meaning, in our example of 10 issues where you would go to C8 appeal on only 1 issue, there's a complete merger of assessment order with that of the C8 appeal. Once the C8 appeal passes the order, and such order cannot be taken in reassessment, no matter the issues are totally different. The serious goof up from the revenues, and I'm sure you would see, if they have heard us now, in 2023 finance bill, you will see a proposal to amend it.
The whole of the reassessment is based on a notice issued under 148. The proviso to 148 says you shall not issue a notice under 148 unless the assessing officer has information with him suggesting income has escaped assessment. Therefore, this information, so to say, is the cornerstone of the entire action. What is this information which suggests income has escaped assessment? There could be various circumstances, and as Chythanya has already put earlier itself, it has to fit in what the statute prescribes as information suggesting escapement of income. Statute has 2 explanations, explanation 1 and explanation 2. Explanation 1 says in the following situations, it shall be a case where income is set, is information, suggesting information is said to exist. In explanation 2, there is the deemed information suggesting escapement of income. So one is a deemed fiction, which says in the following circumstances, for example, search survey cases, there shall be a deemed escapement of, there will be a information suggesting escapement of income. Deemed, statute itself creates this fiction. Explanation 1 under the old law had two conditions only. Information flagged by the RMS strategy and any final objection of the C&AG. They have made changes to these provisions, and it's extremely important for us to understand the nuances and the ramifications of these changes. The word flagged has been removed. So information not flagged, information pertaining to the SSC in relation to the RMS strategy. And the word C&AG final objections have gone away, any audit objection. So changes have been made to the existing provision. To that, they've added 3 more conditions now. What shall be conditions where information suggesting escapement of income is going to exist? Those conditions are information under 90 and 90A, 135 capital A, and a case of any order which requires action, order of a court or a tribunal which requires action to be taken. The wordings are a little loose of all these 5 limbs. Wordings are a little loose. Why am I saying they are a little loose? We'll have an occasion to discuss that when Chythanya takes you individually to these limbs concerned. So the first statement therefore would be referring to 5 circumstances under explanation 1, which talks about information suggesting escapement of income. The law is exhaustive. There is saying that, yeah, it shall mean only this, can't mean anything else. Because of the fact it is mean an exhaustive, you can't go to any other situation where there is income said to be information suggesting escapement of income. This becomes exhaustive, and therefore it becomes very legally relevant for us to understand the real import of what the explanations are trying to tell us. Therefore, we will go into this and then go into explanation 2. We'll therefore confine ourselves now to explanation 1 and explanation 2 as far as 148 is concerned. Then we'll go into the procedure under 148 capital A and reconcile this provision. But before that, let us therefore understand the import and the wording that have gone about, changing the wordings of 2 existing clauses, adding 3 clauses now. The language is a little up and down, not very crisp language that you expect from a statute concern. Let us understand the ramifications of the explanation 1 and explanation 2.
Under 148, before you would make an assessment, reassessment, or recomputation under 147, the assessing officer will have to serve a notice on you under section 148. Up till here, it is just the same as old law. He has to issue notice under 148, correct? Even under S12 regime. But then, his issue of notice to you under 148 is subject to 148A. Meaning, ordinarily, he cannot straight away come and issue a notice under 148. Before he would issue a notice under 148, ordinarily, subject to exceptions which we'll deal with later on, he has to first issue a notice under 148A. Here you pass an order under 148A with the prior approval of the specified authority. On the strength of that order, which is passed under 148A, which is passed after hearing you and with the prior approval of specified authority, he has to now issue notice under 148. Then you are expected to file a return. Is this clear? So, it is not a straightaway issue of notice under 148. Ordinarily, there are some exceptional cases where you can straightaway issue notice under 148. That will come to later on. Okay. Now, this is the requirement of main body of 148. Now, what Mr. Padam mentioned is what is the precondition even to proceed with the procedure of 148A. Even to trigger this, the condition is built into first proviso to 148. that says no notice under this section shall be issued unless there is information with the AO which suggests income chargeable to tax as escaped assessment. That means ISE, information suggesting escapement. And read the other words also carefully. In the case of the assessee for the relevant assessment year. Why I am emphasizing on these extra words in the case of the assessee for the relevant assessment year is for the reason that later on when I'll take you to the definition of ISE, that is information suggesting escapement, ISE, which is given in explanation 1 to 148, it will only define what is ISC. It will only define what is ISC. That is not enough. It has to be ISC in the case of the assessee for the relevant assessment year. Are you able to get me? So you cannot just stop at the meaning as is defined in explanation 1 as to what is ISC. Not enough. Whatever the damn ISC is there in the explanation 1 has to be in the case of the assessee and it has to be for the relevant assessment year. These words are missing there, but will have to be read in by virtue of the proviso. This is what I want to make it very, very clear in the beginning. For every clause of ISC, which you're going to see in explanation 1, these words will have to be appended. Then only you will have the jurisdiction to proceed in terms of the proviso. Are you clear on this? Now, what it says, he has to have information suggesting escapement of income. In the case of the assessee for the relevant assessment year, then he has to have the prior approval of the specified authority, which could be dispensed with only and only if he had passed the order under 148A already with the prior approval of the specified authority. See, because he will have to go under 148A later, pass an order with the prior approval of specified authority. So there is no point in taking one more prior approval for issue of notice. That is why it is dispensed with. You would appreciate it a little later, more better, for the reason that you would know there are some situations where you can straight away issue 148 without having to go through 148A. If in such case you wouldn't have obtained prior approval. See, it's only when you do 148A for passing order under 148A you require the prior approval. Right? If that 148A itself is dispensed with in a given case, then are you permitted to straight away go ahead and issue 148? The answer is no. Then you require a special prior approval. Whole objective is either you have the prior approval under 148A. If not, you have the prior approval under 148. But keep in mind, there cannot be issue of notice under 148 without the prior approval either under that section or under 148A. So at least one prior approval is mandatory sine qua non for issue of this. This has to be understood clearly. Then we will go to explanation 1. Explanation 1 talks about information suggesting escapement of income. You have 5 situations. It says, for the purposes of this section, that is 148, and section 148A, the information with the assessing officer which suggests the income chargeable to tax escaped assessment, ISC in short, meaning what? Exhaustive. So ISC will have to be one or more of these 5, cannot be 6th or 7th item. This is where you recall I was trying to say, unlike in the case of reason to believe, which is very, very wide, ISC will have a very, very, like exhaustive, meaning it has to fit into one or more of these 5 items. It can't be more than these 5 items. Now, there are 5 such items. I'll first take you very briefly, then touch upon some niceties associated with it. Item 1, any information in the case of assessee for the relevant assessment year. This is surplusage because it's already found in proviso. I have already told you. It has to be necessarily in the case of assessee for the relevant assessment year. So those words again coming here is a surplusage. Don't bother about it. Any information in the case of assessee for the relevant assessment year in accordance with the RMS formulated by the board from time to time. So the board will bring in RMS, risk management strategy. On that basis, there has to be an information in your case. Just because, of course, I'll deal with that a little in greater detail a little later. This is item 1, RMS strategy. Second is any audit objection to the effect that the assessment in the case of the assessee for the relevant assessment year, again is, surplusage, has not been made in accordance with the provisions of the Act. Audit objection. I'll again deal with it in a greater detail a little later. Third, information received under an agreement referred to in section, that is DTIA, section 90 and 90A. Then information made available with the AO under section 135A. Again, I'll deal with that. And information requires action in consequence of order of a tribunal or a court. Only these are the situations where there could be information suggesting escapement. This is in explanation 1. If you go to explanation 2, it will enlist 4 situations where there is deemed to be ISC. Are you able to get me? Explanation 1 will give you where there is ISC, 5 situations. Whereas if you go to explanation 2, it will give you 4 situations where merely because you fall in the situation, a fiction is created, a legal fiction is created, that there exists an information suggesting escapement. I call it as DISE, deemed information suggesting escapement. One is actual ISC. Explanation 1, 5 situations. 2, deemed ISC, DISC, 4 situations. So which are the 4 situations? If a search takes place in your place on or after 1/4/2021, no matter what happens in the search, it may be an absolute clean search. Nothing is found. No incriminating material is found. But there is a deemed information suggesting escapement. So first proviso is satisfied. What is the first proviso to 148? Before issue of notice, there has to be information suggesting escapement. Now it is deemed to exist. That requirement is gone. There's another requirement under section 148. Before you issue notice under 148, you have to go to 148A, correct? You realize later, in this kind of a situation, he does not even have to do 148A. He can straight away issue notice under search today, tomorrow notice. Nothing else needs to be done except one requirement. What is that? Prior approval of the specified authority. Because you're not going through 148A. Under 148, you require the specified authority's prior approval. Otherwise, no need to have ISC because it is deemed to exist. No need to follow 148A. Then, look at the second one. A survey takes place. A simple survey takes place. The moment survey takes place, there is DISC. But it is not as bad as search. 148A procedure will have to be followed. So this is where you will find, a lot of positioning various provisions. Like in the case of search, you have 2 difficulties. 1, ISC is deemed to exist. 2, you don't have the protection of 148A also. Gone. Whereas if it is a case of survey, it will only deem that ISC exists, but he has to follow 148A procedure. So you are a little better off here because survey is not as bad as search, right? But in the survey also nothing needs to be found. He has no time to do. He has come and spent some time in your place as a survey under 133A. Good enough. You are deemed to have ISC. Third situation.
Second situation, tedious survey.
See, you have survey under 133A for various purposes. 1 is income-based survey. 2, expenditure-based survey. 3, tedious-based survey. If the survey party comes to you for seeing whether you are compliant with the tedious or not, this disability does not attach to you because it has got nothing to do with your income. Some compliance you are not done, so you should not be troubled as much. So any other survey you are troubled except the tedious survey. A third situation where there is deemed information suggesting escapement is search takes place in his place. They find money, bullion, jewelry, valuable article, a thing in his place, but as belonging to me, search in his place, asset found, but belonging to me. Then both are troubled. As far as he is concerned, DSE, DISC. As far as I am concerned, DISC. Though I am not the such party, I am the other party. But then for such party to conclude that the asset found in his place belongs to me, he should require the prior approval of the specified authority. He cannot on his own, without intervention of higher authority, decide that some of his cash would belong to me, some of his jewelry would belong to me. No. For that, he has to have the prior approval of the principal commissioner or the commissioner. The higher official's permission is required for that. Not specified authority, principal commissioner, commissioner. On that basis, the such party concludes that some of the assets of him would belong to me. Then I am the other party, he is the such party. Both of us, in both of our cases, there is a deemed information suggesting escapement number 1. In both of our cases, 148A procedure is also gone. Straight away, issue notice under 148. Then, asset is not found in his place. Documents are found in his place, which are found to relate to me or pertain to me. Some sale deed which I executed, I kept with him, not disclosed to department. Not an asset, just a sale deed. Some expenditure which I have incurred, which I have never accounted in my books of account, I would have paid in cash. That bill is found in his place, which relates to me or pertains to me. It need not relate to me, but it may pertain to me. I paid him some amount which I wouldn't have accounted. Such party will come to his place and find that, yes, so and so has paid some amount. That voucher pertains to me, which he has written, doesn't relate to me, but it pertains to me. Good enough. He is out, I am out. In both of our cases, it's the case of deemed information escaping assessment, and 148A is dispensed with. Straight away, issue notice under 148. Then, these are the
5 conditions. Go back to 5 conditions.
These are
Explanation 1, 5 conditions.
yeah. Now, see, I've only very broadly, explained to you about ISC, DISC, and when 148A is dispensed with, to some extent I've dealt with. Now let's deal with, each of this. Now, yeah. So now, if you, summarize, for issue of notice under 148, what are the conditions? What are the conditions? There has to be ISC or DISC, correct? 2, he has to follow the procedure of 148A, except in some cases, otherwise he has to do it. 3, he has to have the prior approval of the specified authority. So these 3 conditions will have to be satisfied for issue of notice under 148. Now, merely because this would take you to understand that merely because there is ISC or DASC, it doesn't mean that he can proceed to issue. He has to follow 148A, except where 148A is dispensed with. All this would mean what? If you combine 148 and 148A, for 148, you should first have ISC. That means information suggesting escapement. Then you follow the procedure of 148A. What does it all mean? Your ISC is like raw material that you process under 148A, meaning furnish it to him, hear him, and finally consider that it's a fit case for issue of notice. That is the finished product. The finished product is passing an order under 148A saying that on the basis of ISC, which you are in possession, and after having heard the party, you still consider that's a fit case for issue of notice. That is the end product emerging. Then only you can proceed to issue notice under 148. Now, let's look at each one of the ISC there are some, fundamental aspects that need to be noted here. Information suggesting escapement of income. It is enlisted in 5 items there. For example, in one of the items, they say information collected under section 90 is an information suggesting escapement of income. It cannot be read so. Mere information collected under section 90 cannot qualify and be upgraded to become ISC. The words income escaping assessment will have to be inherently be understood in each of these line item. In each of these line item, these words will have to be inherently understood. Merely because it will fit into that would not mean information suggesting escapement, because these words are critical and they have to be looked into. Now look at the first item here. I will very, very briefly take you through because we don't have much of time. First item of ISC is information in the case of assessee for the relevant assessment year in accordance with RMS formulated by board from time to time. So what is it they're trying to say? The board has some RMS and there is some information in the RMS in your case. Some information in the RMS in your case, they say is the case of information suggesting escapement of income. What is this RMS? Risk management strategy. Could you not ask from the assessing officer, hey, give me what is your RMS? How do you say my case fits in there? Because otherwise, what is the purpose of hearing under 148A? So in our view, whenever a notice comes to you under 148A, where the AO says that yours is an information relating to you in the RMS, you have a duty to ask as to what is the damn RMS. 1. 2. This RMS is, they say, from time to time. They keep on revising their RMS, but then they can do the reassessment for past several years, 3 years or 10 years. Should that RMS be relevant for that year, or should the RMS be seen at the time when he initiates action? It's a question. For example, let us say 22-23 assessment year. During that period, they have brought in an RMS. But for 22-23 assessment, year may be picked for reassessment in 25-26 within the time limit, at which point in time there may be another RMS then. Which RMS should you apply? RMS relevant to assessment year, RMS at the time when it takes action. So, which is not very clear now. Then, in the RMS, for example, risk management strategy, they may just, say in Mr. Padam's case, there are some penny stock transactions, kindly verify, hence issue notice. Would it qualify as ISC? It may qualify as information in his case, but not enough. You cannot use RMS route for fishing and drawing inquiry. Information means it has to be an information available, not to be manufactured. By rowing and fishing inquiry, you are going to create information. No. Explanation 1 doesn't talk about an information which you're hoping to generate. It's an information that exists. So they cannot use the recourse of RMS unless and until that RMS clearly conveys an information suggesting escapement of income. So mere information of RMS, mere caution in the RMS that examine all these cases would not be enough to initiate reassessment, because it would not qualify to be regarded as information suggesting escapement. Now, second thing is it okay? Do we have time?
2 minutes.
It won't be over in 2 minutes.
Yeah, 2-3 minutes, because we have to do 148A.
Yeah, they have talked about audit objections. And, audit objection, there was a law made by the Supreme Court that audit party objection on a point of law is only an opinion and you cannot do reassessment. You have 119 ITR 996, Indian and Eastern Newspapers Society's case, where the point of law noted by audit party is only an opinion, will not permit. If a factual error pointed out by them would have possibly permitted, not the legal error or the legal, like opinion. Now, it looks like it is made topsy-turvy. They have said that the audit party's comment, objection, that the assessment is not made in accordance with law. They have not said which audit. Is it C&AG? Is it 142A? Is it some other audit? But no person unless he is legally competent to make such comment. Somebody says something who is not competent to, who is not an expert in income tax, his objection cannot be taken as your assessment has not been made in accordance with law. Point number one. So it has to be the internal department of income tax who is only competent to comment that assessment is not made in accordance with law. Not even a 142 2A auditor. He can only comment on, he can only audit the books of account. He cannot comment on correctness or otherwise of application of income tax law. For example, 142 2A auditor would come. He's examining books of account. He bump into some earlier year information. If he gives a comment that last year this has not been done in accordance with law, he is not legally competent to make such observation, and that cannot be taken as ISC here. Then the third is 90 and 90A, DTA information collected. See, information may be collected from DTA. Under DTA, information may be collected beyond DTA. Panama leaks, Pandora box leaks, they are not the information collected under 1990 capital A. They cannot be used for saying that there is ISC. ISC means information lawfully, legally collected under agreement made under section 90 and 90 capital A. And 135A is an interesting thing. Of course, for want of time, we may not be able to do that. See, there are various provisions in the Income Tax Act, like section 133, like section 133B, 133C, 134, inspection of register of members, 135. All these are also made phaseless now, collection of information. All this information is collected in a phaseless manner and will be given to respective assessing authorities to use in respect of various assessees. That would also constitute ISC now. And fifth is which a consequential order as a result of a tribunal order and a court order. So it will take some time to discuss, so I'll skip this. So these are the situations where, your income, there is an information that suggests that income has escaped assessment. And I've already explained you very broadly, explanation 2, though there is no information suggesting escapement, it is deemed that there is information suggesting escapement in 4 cases. Which are the 4 cases? Search in your place, survey in your place, search in somebody else's place, but your assets are found, search in somebody else's place, but the documents found there would pertain to or relate to you. So these are the 4 situations where it is deemed that the information suggesting escapement exists.
There are some questions that are there online. People also would have asked questions here. But between the process of answering questions and completing the topic, we will, in my opinion, I will prefer the completion of topic. Therefore, yeah, copy and sharing, but the question is of discussion in a public forum for everybody else to benefit. That benefit may not be available, in my opinion, because we have already come to 8:05, about 10 minutes more. And between the option of answering questions and completing the topic, I thought personally, let us complete the topic. We've done some amount of discussion. We've come to some sort of an analysis of the provisions concerned in reasonable detail. Let us therefore complete one segment up till some portions we wouldn't have dealt with. Yes, because there will be some more portion dealt with. But in our opinion, where we will stop today in about 10-15 minutes time will be a comprehensive coverage. What wouldn't have been covered would be minor topics. Both the analysis, what we've done now, and with the spirit of what has been discussed, you'll be able to take advantage of this discussion to go about some minor provision that we will not be able to complete today. Therefore, we will complete the process of the law. One section that remains discussion is 148 capital A, which is a procedure to be adopted for the purpose of issuing a notice under 148. Before you issue a notice, you have to complete with the process of 148 capital A, where 4 subclauses are there. Clause A says AO can make an inquiry. Under clause B, he will have to give an opportunity to the assessee concerned to say, this is the information I've collected. What do you have to talk about in relation to this information? C will talk about the AO considering the reply of the assessee, and clause D will talk about AO on the basis of that reply and all of the materials concerned will pass an order in writing to say, yes, now, in my opinion, after having gone through the entire process concerned, this is a fit case for the purpose of issuance of notice under 148. These words are extremely important. It's a fit case for the purpose of issuance of notice under 148. This goes on to the original point that Chythanya made On the concept of reasons to believe, one portion, no. On the concept of income has escaped assessment, is it a factual finding? Is it a confirmed finding? Is it a prerequisite? Possibly these wordings under clause D would say this is a fit case for the purpose of issuance of 148. Would be some sort of a preliminary conclusion that yes, on a consideration, on a judicious consideration of the materials I have, the inquiry I have conducted, the reply I have given, I have come to a conclusion now that this is a fit case for the issuance of notice under 148. And there is a proviso to say that in the following circumstances, the procedure of 148A need not be followed. Some reference was already made by Chythanya in relation to search cases and survey cases. There's also one more reference to 135 capital A that you will have to therefore go about in saying that in situations covered by 135 capital A, there may not be a requirement of complying with the procedure laid down under 148 capital A. Therefore, we'll understand now the procedure under 148 capital A and find out the exceptions where the procedure under 148A need not be complied with by the assessing officer. Yeah, again, after that, we'll have a last point to say that today, with the GK and drive shaft principles giving us the opportunity or the appropriate time when to go for writ petition, in the altered frame of law, or in the altered regime today, what will be the appropriate time for us to approach the court concerned? Should I wait for the return coming in? Or should I wait for the notice, reply to the notice, and then go to writ petition? Or an earlier stage would be an appropriate time for us to go to writ petition. If an earlier stage, what should be the earlier stage before I go to the High Court in a writ petition? With that, there are some conditions thereafter. 148 capital B, 149 1 capital A. There are some important conditions there. But I think with this discussion that we would have done the substance of the entire aspect of assessment and reassessment, some principles emerging out of the new sections concerned, which have not been addressed by us today, may possibly be understood in the light of the principles that we have discussed today in the course of discussing these provisions.
Let me be as brief as possible. 148 says he can issue notice under 148 subject to 148A. So as I've said earlier, he has to do the checker of 148A before he will issue notice under 148. So what he will do under 148A? Look at this. Before issuing any notice under 148, AO shall conduct an inquiry if required with the prior approval of the specified authority with respect to information suggesting escapement. He has ISC in his possession. So what he has to do with that? He may do further investigation there, inquiry there. But if he has to work further on ISC, meaning he is doing some more rowing and fishing inquiry, he needs the permission of specified authority. With that, he can further develop ISC. If ISC is not strong enough, he can make it strong enough by further inquiry. That is clause A. Then what he has to do? He has to hear the assessee. He has to issue a notice to the assessee, giving a time not less than 7 days, but not more than 30 days. And of course, extending time from time to time. A notice, a show cause notice to the assessee. Tell me why I should not issue you notice under 148 on the basis of information which I have in my possession, suggesting that income has escaped assessment. And if I've carried out any further inquiry, I'll have to give that as well to the assessee. I'll have to show a cause as to tell me why I should not issue you notice under 148. Then I have to consider the reply of the assessee, whatever response he gives to show cause notice. Then most important to look at D here. Decide on the basis of material available on record, including reply of the assessee. I have to decide whether or not it's a fit case for issue of notice under 148, and I have to pass this in an order in writing. And this order which I have to pass, that yes, it's a fit case for issue of notice under 148, will have to be the prior approval of the prescribed authority. That means there has to be prior approval, not post facto approval. Prior approval will have to be obtained. Then I will have to pass this order within what time? Within 1 month from the end of the month in which the reply is received to my show cause notice to the assessee, or within 1 month from the end of the month in which the time to reply lapses, where the assessee does not bother about the show cause notice. So there is a time limit within which I will have to pass this order under 148A. It's only after I do this, I can issue notice under 148. So what I'll do, I'll issue notice under 148 after having passed an order under 148A. So what I have to do, along with 148, I will also have to serve you the order which I have passed under 148A. What will you do with that? You get a notice along with an order under 148A. What you can do? Then, can you go to High Court on a writ petition? See, once he has issued you notice under 148, as far as AO is concerned, it is an irreversible action that he has taken. That he's going to, he has already issued. And now we'll assume jurisdiction under 147. Then, if you are aggrieved by the order of 148A, you could be aggrieved for various reasons. One, 148A is not a speaking order. Two, in the course of hearing under 148A, he has not given you what is ISC. He has not furnished information. He may have made various inquiries to improve ISC, which inquiries are not shared with you. So he has passed an 148A without indicating escapement of income. He simply passed some order. It doesn't in any manner let anyone know that there is an income that has escaped assessment. In all these cases, you can go to, because there is no appeal for 148A remedy. No order, no appellate remedy for 148A. So you can go on a writ petition. Now with this, when is 148A not required? Some of which I've already told you. Search in his case, he is out. No 148A. Survey in his case, there is DISC, but 148A will have to be followed. So there is a difference between search and survey, which will have to be noted carefully. Third, second situation, search in him, but asset found relating to me. In both of our cases, no need for 148A. Search in him, documents of mine are found there, or his documents pertain to me or relate to me. In both of our cases, no 148A. And there's one more situation of 135A information suggesting escapement of income. In this case, also no need for 148A. So you have to reconcile between explanations 1 and 2 to 148 and the proviso to 148A to see as to how various items are found scattered at various places. Some of them would overlap, some of them would not overlap, because the search and seizure would overlap, both the case of DISC as well as dispensation of 148A. Whereas in the case of survey, there is no overlap. It is found for DISC, it is not found for dispensation of 148A. In the case of 135A information, again, it is only found for dispensation of 148A, but it is part of basic ISC and it's not a deemed ISC. So like this, you will have some sort of a reconciliation situation between these provisions.
Time available.
Yes.
We have done what we believe to be the effort from our side to put forth the ideas that we discussed over the last 5 days. That's the benefit we had. And we thank therefore the Bangalore branch for giving us this opportunity, for giving us the opportunity to learn, discuss, debate, and put forth certain ideas that emerged during the course of a discussion for the consumption of all of the people concerned, both who are physically present here and those who are there online with us. Because we have spent a good amount of time, 4 hours discussing that. Still, we have not been able to complete. And to that extent, therefore, we have not done justice to the topic, to the extent of points not covered by us. Not a very great deal that remains not discussed. That one portion of the story we have not been able to justify. And second would be the question from the audience concerned. We have not been able to answer those questions concerned. If an opportunity comes about in the near future, we will take these questions. And if there is an opportunity, we're coming back to this topic concerned, we will be trying answering the questions. But at least for the benefit of us who have done with the topic concerned, we will take the questions from the chairman concerned and look into whether there's a need for us to improve ourselves, look at the thoughts, look at some nuances, and if possible, we can share with the audience concerned also here. But they'll also be able to relate to say that something more is to be done, because this is an emerging topic. We spent a good amount of time. This doesn't mean that today what we discussed is the end of the story. Many more things will come during the course of our deliberations as we go on improving our thought process and as we understand more nuances of the law concerned. tomorrow courts are going to also give their interpretation to these topics concerned. They may agree with us, they may improve upon it, they may disagree with us, but the process of learning concerned. We have been immensely benefited by this process of learning, and therefore thanks the Bangalore branch for giving us this opportunity concerned, and over to the organizers for completing the formality. Thank you all very much.
Thank you, sir. Definitely, your session did help us in getting a value addition to our knowledge kitty this evening. I request our chairman to hand over a memento as a mark of gratitude and respect. Also, I request our treasurer who is here, CM Manjunath Halur, to come up on the dais and present a memento to Chythanya, sir. Thank you. Thank you, sir. Definitely, we had a great evening with the wonderful insights on the assessments. On Bangalore branch of SIRC, I thank each and everyone, members present physically and virtually. We have a great evening. Thank you. Thank you, everyone.